starting with the new revisionary test paper of CA Final SFM November 2021 revisionary test paper. The examination is already postponed to December. As usual, so we will be solving the entire revisionary test paper and then we will understand its summary, that's from which chapters the questions have been provided by the institute. Starting with the question number 1, it is from the chapter of the security valuation, and over here the concept of the duration is provided by them. Mr. A will need an amount of rupees 1 lakh after 2 years, for which he wants to make one-time necessary investment right now. He has a choice of 2 types of bonds. The details are as below: bond X and bond Y. Face value is provided to us in respect of each of them. Rate of interest, that is the coupon rate, is provided to us 7% and 8%. Number of years to maturity is given as 1 year and 4 years. P0, current market price of the current market price of the security is given to us 972.73 and 936.52. Current yield means the price of the security is such that it gives a return of 10% to the investor, and in absence of any information, this itself must be the required rate of return of the investor. Advise Mr. A whether he should invest all his money in one of the type of the bond or he should buy both the bonds, and if so, in which quantity, that is whatever your answer is, to invest in one bond or so to invest in both bonds. In that, what is the quantity in which you should make investment? Assume that there will not be any call risk or default risk. That is the way they have provided with the question. Let us have understanding that's how we can make the computation of answer. See what happens, that an information is provided to us regarding bond X and bond Y. Face value, that is of no use to us. Rate of interest, again it is of not useful to us. Why? Because the question is providing that both of them are providing the same return. Time period to maturity, this is relevant information for the time being, that is 1 year and 4 years. P0, nothing important because it is the present value of the future cash flow. Discounting rate is 10%, that is again no use. Why? Because it is same. Now the important point of the question as a student, that you need to focus is that you are going to have the requirement of the funds after 2 years. What is the amount which is required? It is an amount of 1 lakh. What is the cost of capital? Cost of capital is 10%. So we can say something like this: it is year 0, end of year 1 and end of year 2. Listen me carefully. This is the point at which you require an amount of 1 lakh. So today, what is the amount that you are supposed to invest? That is what we are required to calculate. It's very simple to find. It is the present value of the future amount. So we can say it is 1 lakh divided by 1.10 raised to 2. So it is 1.21. So 1 lakh upon 1.21, that comes to 82,644.62 or 63. So if at all you require an amount of 1 lakh after 2 years, then today you are supposed to make investment of 82,644.63. Making this amount of the investment today, after 2 years you will fetch an amount of rupees 1 lakh. Okay. Now of course we are required to make investment of the funds. The important point of the question is that should you invest in X or should you invest in Y, or you should invest in both of them? And if at all we are going to invest in both of them, then in that case, in which proportion we should make investment? That is a question. For that, the starting point of the question is calculation of duration of security Y. That is the starting point of the question. Dear students, in case of the security X, the redemption value is 1 year only. So this 1 year itself becomes the duration of the security. In case of security Y, there will be certain cash inflow during this 3 years, and say the 4th year you will get further cash inflow in form of the interest income and in form of the redemption value of the investment. So in that case the duration will be less than 4 years. Suppose by chance we find the duration of the security Y as exactly 2 years, then in that case we will advise that say you should invest only in security Y. That is the way we are required to give answer. So let us first of all check that what is the duration for security Y. That is what's the first starting point of the question. If at all you make investment only in X, then in that case what kind of issue is there? Basically there is an issue like this. At the end of the first year you will get the redemption value, yes. At the end of the first year you will get the interest income, yes. Now at the end of year 1, whenever you receive this amount and you are reinvesting the same for another 1 year, it may happen that say the rate of interest in the market, or we can say that say the capitalization rate in the market might have fallen down. In that case you will be having say a risk that is given a name as the reinvestment rate risk. So investment only in X is not making a sense. That is the first thing that we understand. Second point, listen me carefully what I am going to speak. If at all you make investment only in security Y, then in that case what kind of issue will be there? That we are going to discuss say once we are making computation for the duration for the security Y, and based on that say we are going to have further understanding. So working note number 1, calculation of dy, that is duration of security Y. Let us understand, let's say, how to make the computation of the answer. Column number 1 is year. We can see that say 1000 rupees is the face value, yes. Rate of interest is 8%, yes. The face value of the security is 1000, the rate of interest is 8%. So year 1, year 2, year 3, year 4. That is cash inflow, I am writing directly. It is an amount of 1000 rupees into 8%. That comes to 80 rupees in the first year, 80 rupees in the second year, 80 rupees in the third year, 80 rupees in the fourth year, plus 1000 rupees is the redemption value. So it is 1080 is the redemption value of the security. Now we will discount the cash flow series. What is the rate at which it will be discounted? 10%. Cash flows into present value factor will give the present value. Then whatever the amount of the present value that we get and the total of that is P0, based on that we will get the proportion. Then proportion into year. That is the way we will make the computation of the duration of the security. That is the way we are required to make the computation of the duration of the security. Discounting rate is 10%. Year 1 factor is 0.9091. Second year factor is 0.8264. Third year factor is 0.7513. Fourth year factor is 0.6830. Now we compute its present value. So 80 into 0.9091, that comes to 72.728 or 72.73. 80 into 0.8264, 66.11. 80 into 0.7513, 60 rupees 10 paise. Dear students, we already have been provided with the P0. It is 936.52. So we'll compute the fourth year value as balancing figure. Otherwise the answer will not tell you. 72.73 plus 66.11 plus 60.10. So 198.94 is subtracted from 936.52. So 737.58. So 1080 into 0.683 is 737.64, but there is some marginal difference which we have to consider like this only. Now 72.73 upon 936.52, 0.0777. For the next year it is 0.0706. For next year it is 0.0642. For the next year it is 0.7876. Let us see that the total is 1 or not. 0.0777 plus 0.0706 plus 0.0642 plus 0.7876. So I make it 75 because the total is exceeding 1. So the total is exactly 1. Now whatever the proportion that we find into year, so this into 1 year, 0.0777, 0.0706 into 2, 0.1412, 0.0642 into 3, 0.1926, 7875 into 4, that is 3.15. So the duration is 0.0777 plus 0.1412 plus 0.1926 plus 3.15, 3.5615. This is the way we are required to make the computation of the duration of the security. Now importantly friends, this duration is not 2 years. There was a chance, there was a possibility that it could be 2 years, but it is not 2 years. It is more than 2 years. So what happens that say we are required to make investment in combination of X and Y, so that the duration is exactly 2 years, because that is the point at which we require the cash flow. We understand importantly that if at all we invest only in security Y, then what will happen? First year, second year, third year and fourth year. this internal cash accrual will be reinvested. When you will reinvest, then the third year cash accrual reinvested for 1 year. Second year cash accrual is reinvested for 2 years. First year cash accrual is reinvested for 3 years. That is what say we do. However, say importantly we are required to say sell the security at the end of the second year. Why? Because at the end of the second year we require the amount. So the first year amount that we receive will be compounded to second year. Second year cash flow we will keep as it is. The third and fourth year cash flow will be discounted to second year end. Again this is discounted to second year end. And that is the way we are required to compute that say what amount we are going to receive at that point of time. Now it may happen friends that if at all we invest only in security Y, then in that case at the end of the second year the rate of interest in the market increases. The capitalization rate increases in the market. And because of that, say whatever the price of the security which we are going to fetch at the end of the second year will be less. So we have to make a combination of the security X and Y in certain proportion so that the duration of the portfolio is exactly 2 years. Now in which proportion we will make investment? Let us calculate the same. So calculation of proportion in which investment to be made in X and Y, comma, so that overall duration of portfolio is 2 years. So let us see how to make the calculation of answer. It is security X and security Y. Weight or proportion Wx 1 minus Wx duration is 1 year, 3.5615. Weight into duration, Wx into 1 is Wx, 3.5615 minus 3.5615 Wx. The overall duration of the portfolio is 2 years. That is the way, so the Wx is required to be found. So the answer of the question is duration of the portfolio is equal to Wx plus 3.5615 minus 3.5615 Wx. So now it is 2.5615 Wx is equal to, okay, this 2 is transferred on the opposite side, so this will become positive and this will become negative. 3.5615 minus, what is the duration of the portfolio? Duration of the portfolio is 2 years. (1.5615) upon 2.5615. That is the way the Wx can be calculated. .7192. That is the Wx. So there is a calculation on 1.5615 divided by 2.5615. So 0.6096. So approximately 61% is required to be say invested say in security X. Remaining will be invested in security Y. Now the remaining answer is extremely simple. Let us make this as working note number 2. Working note number 3. Calculation of amount of investment to be made. It is 1 lakh divided by future value interest factor at the rate of 10% for 2 years. 1 lakh divided by 1.21, 82,645. That is the amount of the investment which is supposed to be made. Calculation of number of securities to be purchased. Now in that, security X, security Y, amount, this is 82,645 into 0.6096. So 82645 into 0.6096. So 50380. The total amount is 82645 minus 50380. So 32265. P0, current market price of the security. For security X it is 972.73. And for security Y it is 936.52. So next will be number of securities to be purchased. So what will happen? It is 50380 divided by 972.73. So it comes to 51.79. So let us take 52 securities and 32265 divided by 936.52. So 34.45. So let us take 35 securities. That is the way the amount of the investment to be made and number of securities to be purchased. So these are the number of securities that say you are required to purchase. So going back to the question, advise Mr. A whether he should invest all his money in one type of bond or he should buy both the bonds. So we understand that say Mr. A should purchase both bonds. Full stop. If so, in which quantity Mr. A should buy security X 52 and security Y 35. Assume that there will not be any call risk or default risk. Call risk means, say, there will not be any time that in between this 4 years, so the company will redeem the security in between. There is a call feature which a security may have, wherein the company has a right to call back the security in between. And default means that's on the redemption. It will not happen that, say, the security will not be redeemed. That is the default risk. Next question, question number 2. The following data is related to 8.5%, that is the stated rate of interest, fully convertible into equity shares debentures issued by JAC Limited at rupees 1000. Current market price of the debenture is rupees 900. Conversion ratio is 30. That is, one debenture will be converted into 30 equity shares. Straight value of the debenture is 700. It means that without conversion feature, similar debentures have a market price of 700. Market price of the equity share on the date of conversion is 25 rupees. That is, current market price is given. Expected dividend per share is rupee 1. The first question is, you are required to make the calculation conversion value of the debenture. Conversion value of the debenture stands for what would be the value of the equity shares if the debenture is converted into equity shares. We can see that the conversion ratio is provided to us as 3030 and market price is 25. So 30 into 25, that comes to 750. So answer of the A part of the question, conversion value of debenture. It will be calculated as market price of the equity share into conversion ratio. So it is 25 rupees per share into conversion ratio is 30. That comes to rupees 750. That is the conversion value of the debenture. Next question, market conversion price. What does it mean? It means that we are required to calculate such market price of the equity share at which the conversion value of the debenture is equal to market price of the debenture. So B question, market conversion price. In that, conversion value of the debenture is equal to market price of equity share into conversion ratio. And this market price of the equity share is what we understand is the market conversion price. So market conversion price is equal to conversion value of the debenture is equal to market price of the debenture divided by conversion ratio. Market price of the debenture is 900 and the conversion ratio is 30. That comes to 30 rupees per share. Third question, conversion premium per share. That's very simple. Conversion premium per share. Dear students, it will be calculated like this. Market price of the debenture minus conversion value divided by conversion ratio. Market price of the debenture is an amount of rupees 900 minus conversion value is an amount of rupees 750 divided by the conversion ratio is 30. So it is 900 minus 750, 150 divided by 30, that is 5 rupees per share. And this 5 rupees per share can also be cross verified as 30 rupees minus 25 rupees. 30 rupees is considered to be the market conversion price which we have calculated minus the current market price of the equity share. Next question, ratio of the conversion premium. Whatever the conversion premium that we have calculated, that is going to be used for calculation of the ratio of the conversion premium. It will be calculated as conversion premium divided by market price of equity share into 100. So 5 rupees is the conversion premium. Market price of the equity share is 25. So the final answer is going to be 20%. That is ratio of the conversion premium. Premium over straight value of the debenture. Dear students, over here we understand something like this, that conversion premium stands for that what is the excess amount that you pay when you purchase the convertible debenture in comparison to purchasing of the equity shares. If at all you purchase 30 equity shares, then 30 into 25, you have to pay only 750. But when you purchase the debenture, then in that case you pay rupees 900. So you are paying 150 rupees more? Yes. Per share it is 5 more? Yes. Now we understand logic behind that like this, that why do I pay premium? Because in case of the equity share, there is only risk. I am not at all having any assurance of the return. When I purchase the debenture, then what will happen? that say in case of the simple debenture, I'll get the fixed amount of the cash flow, whatever may be the performance of the company. Rather, we understand that say if at all the performance of the company is becoming better, then later on say they pay lower rate of interest. Yes, if at all your credit rating increases, then in that case of course you will borrow at the lower rate. So now as an investor I feel that say I do not want to take too much risk, and at the same time I want to participate say the company's growth. So in between both of them, say there is a security like convertible security. What happens that say this will give me a fixed amount of the cash flow at least for a certain number of years, and after that I will be protected that either I will get the redemption value or the conversion option. That is the reason say I am making payment of the premium. So by that time, so the redemption comes. If at all the performance of the company has improved, then in that case I will go for the conversion, and if at all the performance has not improved, then in that case say I will go for the simple redemption value. So let us go back to the working, wherein we are required to make the computation of the premium over the straight value of the debenture. Straight value of the debenture stands for without conversion feature. What would be the market price of the security? Is straight value of the debenture, that is 700. Now we understand that say market price of this convertible security is 900. So difference of both of them is considered to be the premium over the straight value of the debenture. So answer of E question, premium over straight value of the debenture. In that write down market price of convertible security divided by straight value of debenture minus 1. So we understand that so the market price of the convertible security is an amount of rupees 900. Straight value means market price of the similar security without conversion feature is 700 minus 1. So over here 1.2857. That is 28.57%. Now these two are the questions which I think are really very good questions. Favorable income differential per share. Now really a good question. Suppose I purchase a debenture, then in that case we understand that 1000 rupees is the face value and the rate of interest is 8.5%. That comes to an amount of rupees 85. That is interest income. Next question. So if at all I purchase the debenture, then in that case I'll get the interest income of rupees 85. If at all I would have purchased 30 equity shares, okay, per share I will get dividend of rupee 1. So 30 into 1, that comes to 30. So can we say that say purchasing of that is debenture will give incremental income of 55. The conversion ratio is 30. So purchasing of debenture will give me incremental income of 55 rupees, for 30 shares. So 55 upon 30. Per share I will get higher amount by 1.83333. That is the favorable income differential per share. See, what you have to keep in your mind is that say you are purchasing one debenture instead of 30 equity shares. So in that case, say purchasing of one debenture will give you say higher amount of the income. How much higher amount? 55. And this income is corresponding to say 30 equity shares. So per share it is like 1.8333. So right answer. F question. Favorable income differential per share. In that, interest income minus dividend income divided by the conversion ratio. Interest income is 1000 into 8.5% minus 30 shares into 1 rupee per share divided by 30 shares. So 85 minus 30 upon 30. So 55 upon 30. So it is 1.83 rupees per share. This is the way income differential per share can be calculated. Premium payback period. Again, I found it to be really a good question. So if at all I purchase one debenture instead of purchasing 30 equity shares, I pay premium. Yes. Why? Because 30 into 25, it comes to an amount of 750. 750 is greater than 900. By how much amount? 150. Now every year you are able to recover the amount of 55 rupees. So we understand that say in 1 year you are able to recover 55 rupees. How 55 rupees? That is what we have recently calculated. So it will take what time period for you to recover the premium that say you have paid to purchase the debenture? How much premium? 150 rupees. That is 900 minus 750. So 150 upon 55. That comes to 2.73 years. So it will take this time period say for the purpose of recovering, for the purpose of recouping say the investment. So answer of the G question. Calculation of premium payback period. We understand that's the year and amount. Every year you are able to recoup an amount of rupees 55. That comes to rupees 85 minus rupees 30. So it will take this number of years say to recoup the amount of the additional investment, that is the premium which you have paid, and the amount of the premium is rupees 150. That comes to 900 minus 750. So 150 into 1 divided by 55, that comes to 2.73 years. So it will take this much time period for the purpose of recovering the investment that say you have made in debenture. Next question, question number 3. It is a question from the chapter of portfolio management. Before that, so let us just have a revision of the entire answer. The first question is calculation of the conversion value of the debenture. Means the conversion ratio into market price of the equity share. It means that say if at all today itself the debenture is converted into equity share, then in that case what will be the value of the equity instrument? That is the first question answer. Market conversion price. This is quite again say important to some extent. What should be the market price of the equity share, so that the conversion value of the convertible security is equal to market price of the debenture? That is the second question. Third, conversion premium per share. Now conversion premium per share means that say when you purchase the debenture in comparison to the equity share, what is the additional amount that say you have to pay? You purchase the debenture, you have to pay 30. Otherwise, in case of the equity share, you would have paid 25. So 5 rupees is the premium which you pay. Ratio of the conversion premium. 5 rupees is the premium which is paid over, say, the 25 rupees. So it comes to like 20%. That is the ratio of the conversion premium. Premium over straight value of the debenture means if at all you purchase the plain debenture, then in that case it has a value of 700. When you purchase a debenture with the conversion feature, the market price is 900. So the excess amount which is paid is considered to be the premium, and that is what we are required to compute premium over the straight value of the debenture. Favorable income differential per share. We understand that when you purchase the debenture, you get the interest income of 85. Otherwise, purchasing of the 30 equity shares, you will get an amount of 30 rupees per share. Why? Because the dividend is given as rupee 1. So we understand that you get an amount of 55 rupees more for every 30 shares. So the favorable income per share, income differential per share, is 1 rupee 83 paise. And the last is the premium payback period. Means whatever the excess amount which you pay, so that is going to be recovered in how many years? 2.73 years. Because in 1 year you are able to recover 55. So in how many years you will be able to recover 150? It is 2.73 years. That is what we understand. Next question from the chapter of the portfolio management. Mr. A is interested to invest an amount of rupees 1 lakh in the securities market. He selected two securities B and D for this purpose. The risk return profile of these securities are as follows. So information is provided to us in terms of the standard deviation and in terms of the return. Coefficient of correlation between both of them is 0.15. You are required to calculate the portfolio return of the following portfolios of B and D to be considered by Mr. A for his investment. 100% investment is made in security B. Then in that case it's very simple, that the return will be 12 and the risk will be 10. 50-50. So in that case we are required to compute the return and standard deviation. 75-25. Again we have to compute. And 100% in D, wherein we understand and say return will be this much and risk will be this much. So basically there are only two calculations which are required to be made. That is just two. So let us, that is say, prepare its working note, and then we are going to calculate the, that is we are going to present the entire answer that what will be the return and risk for the different portfolios. So I am starting with the second portfolio. Second portfolio is 50% investment is made in B and 50% in D. So working note number 1, calculation of return of portfolio for investment made in both securities in equal proportion. Weight of B into return of B, weight of D into return of D. So it is half of investment is made. 0.50 into 12, 0.50 into 20. Six plus 10, that comes to 16%. That is the way the return of the portfolio can be calculated. Working note number 2, calculation of variance and standard deviation of portfolio, comma, investment made in both securities in equal proportion. So let us see that the investment is made in both of them in equal proportion. Sigma P square is equal to WB square sigma B square, WD square sigma D square, 2 into R into WB WD sigma B sigma D. What is WB square? We understand it is 0.50 raised to 2, 0.50 raised to 2 once again. Standard deviation is 10 and 18. This is 10 and this is 18. 2 into R. R stands for correlation coefficient, which is provided over here as 0.15. Into weight of individual security into standard deviation of the individual security. So square of 10 is 100, square of 0.5 is 0.25. So the total is 25. Square of 18 is 324 and square of 0.5 is 0.25. That comes to 81. Two into 0.15, that comes to 0.0, that is 0.30, into 0.5, that is 0.15, into 0.5 is 0.075, into 180, that comes to 13.5. 25 plus 81 plus 13.5, that is 119.5. That is the way the variance of the portfolio can be calculated. Once we compute the variance of the portfolio, then standard deviation of portfolio. So root of 119.50, 10.93%. That is the way the standard deviation of the portfolio can be calculated. Working note number 3. Calculation of return of portfolio for investment made in B and D. %, 25% respectively. So in that case, WB into RB, WD into RD, 75-25, multiplying with the respective return. Return is 12 and 20. Friends, just be slightly careful. Sometimes institute is say changing the order. They mention D and B. Okay, so just be little bit careful. So 12 into 0.75, 9. 0.25 into 20, that comes to 5. That comes to overall 14%. That is the way the return of the portfolio can be calculated. Working note number 4. Calculation of variance of portfolio if WB is 0.75 and WD is 0.25. Okay. And its sigma p also. We'll compute the standard deviation simultaneously. WB square sigma b square, WD square sigma d square, 2 into R into WB WD sigma b sigma d. So 0.75 square, 0.25 square. Then the standard deviation is 10 and 18. It is 10%. 2 into R, correlation coefficient, 0.15 into WB is 0.75, WD is 0.25 into 10 into 18. So square of 0.75 is 0.5625 into square of 10 is 100. Square of 0.25 is 0.0625 into square of 18, 20.25. Two into R, 0.15 into 0.75 into 0.25 into 180. that is 10.125. So 56.25 plus 20.25 plus 10.125, 86.625. Now based on this we'll compute the standard deviation. So under root of 86.625, 9.3073. That is the way the standard deviation of the portfolio can be calculated. Once you compute the variance and then standard deviation. For the first and the last one, the answers are provided along with the question. So now we will prepare a final summary. We have been provided with 4 portfolios. WB, WD, RP, Sigma P. Portfolio 1, Portfolio 2, Portfolio 3, Portfolio 4. For each of the portfolio, we are required to compute the return and standard deviation. So the first portfolio is the entire investment is made in B and nothing is invested in D. In that case, so the return of the portfolio will be 12% and standard deviation will be 10%. Second portfolio, in which investment is made 50-50. We already have computed the return and risk. The return is 16% and standard deviation is 10.93. So here 16 and 10.93. That is the way the risk and return we already have found. The third is 75% in B and 25% in D for Delhi. In that case, the return is 14 and this is 9.3073. The last portfolio is the investment is made in D for Delhi and nothing is invested in B for Bombay. In that case, the return is going to be 20% and the standard deviation is going to be 18%. This is what the final summary of the answer. Also indicate which portfolio is best from the point of view of the risk as well as from the return point of view. So we are required to make this identification. So friends, over here it is very simple to identify. From the return point of view, the fourth portfolio is the best portfolio. From return point of view, fourth portfolio is the best portfolio. Why? Because it is having the highest return. That is what we understand. And from the risk point of view, the third portfolio is the best portfolio. Why? Because it is having lowest risk. So write down answer. From risk point of view, comma, third portfolio is best, comma, because it has lowest risk And from a return point of view, fourth portfolio is best, comma, as it has highest return. This is what we understand. Question number 4. A portfolio manager has following 4 stocks in his portfolio: VSL, CSL, SML, APL. Number of shares have been given to us, market price is given to us, and the respective beta is given to us. Compute the following. The first question is the beta of the portfolio is supposed to be calculated. So what we will do, we'll make the computation of the proportion of individual security in the portfolio. How to compute the same? It is 10,000 into 50, that will give the market value. 5,000 into 20, again market value. Total of that, then we'll compute the proportion into beta. That is the way the weighted average will be calculated, and that is beta of the portfolio. That is the way we have to work out the first part of the question. So please write down answer. Calculation of beta of portfolio. In that, column number 1 is name of security. Column number 2 is value of security. Weight / proportion. Beta, weight into beta. That is the way the weighted average value will be calculated, and that is beta of the portfolio. This is the way we are required to prepare the table. Now, as far as the first VSL is concerned, in that there are 10,000 securities, market price is 50. So in that case, it comes to 5 lakhs. Next is again 5,000 securities, price is 20, so amount is 1 lakh. Then 8,000 securities into 25, it comes to 2 lakhs. $2,000 securities into 200, it comes to 4 lakhs. 5 plus 1, 6, 6 plus 2, 8, 8 plus 4, that comes to 12 lakhs. So the total amount of the portfolio is 12 lakhs. Weight or proportion is 5 divided by 12. 1 divided by 12. Then 2 divided by 12. Then 4 divided by 12. And the total is of course 1. That is the proportion in which the investment is made. Beta is provided to us 0.901, 1.50, 1.20. Weight into beta, and weighted average of the same is beta of the portfolio. So we understand that's over here 5 divided by 12 into 0.9. 0.375, 1 divided by 12 into 1, 0.0833, then 2 divided by 12 into 1.5, 0.25, 4 divided by 12 into 1.2, 0.40. That is the way the beta of the portfolio can be calculated. So the total of all of them is 0.0375 plus, 0.375 plus 0.0833 plus 0.25 plus 0.4, 1.1083. That is the way beta of the portfolio can be found. So beta of the portfolio is 1.1083. Next, if the portfolio manager seeks to reduce beta from 1.1083 to 0.8, how much risk-free security should he bring in? So answer for the second part of the question. Calculation of amount of risk-free security to be purchased, comma, so that beta of portfolio reduces to 0.80. So investment in risk-free security and existing portfolio. Weight / proportion. Let us assume that this is Wx, this will be 1 minus Wx. Beta is of course 0 for the risk-free security, no risk, 1.1083. Weight into beta. Weighted average is beta of the portfolio, which should be equal to 0.8. Accordingly, we are required to find weight of X. So weight into beta, so 0 over here, and 1.1083 minus 1.1083 Wx. Now we'll compute the Wx as balancing figure. 1.1083 minus 1.1083 Wx is equal to 0.8. Now this value is transferred on the opposite side, so it will become positive. This will go on the left hand side, so it will become negative. So difference between both of them is 1.1083 minus 0.8. So 0.3083 divided by 1.1083. So 0.2782. So that should be the proportion of the risk-free security in the portfolio. Now friends, we understand once we compute the weight of the risk-free security, then we'll compute the weight of the existing portfolio, and based on that, the amount. So calculation of amount of investment. Risk-free security, then existing portfolio. Weight 0.2782. Total is 1. .7218. Amount. This is an amount of 12 lakhs. So 12 lakhs divided by 0.7218. That comes to 16,62,510. Twelve lakhs divided by 0.7218. So 16,62,510 minus 12 lakhs. That comes to 462,510. This is the way, so we are required to make the computation of the amount of the investment to be made in a risk-free security so that the beta of the portfolio will reduce to 0.80. This is the way we are required to give answer for the second question. Third question, if the portfolio manager seeks to increase beta to 1.20 from 1.1083, how much risk-free security should he bring in? That is a question. So again, answering of the fourth question is very simple. That is answering for the third question. In order to increase the risk, comma, investor is required to borrow and invest. Full stop. Amount of borrowing is found as under. So investment in existing portfolio, and for risk-free friends, this time it will be borrowing, so it will have the negative weight, so negative Wx, and the investment in the existing portfolio will be 1 plus Wx. That is the way we will have the weight, and of course the total of the weight would be 1. Multiplying with the beta. Beta for the existing portfolio is found as 1.1083. This is 0. Accordingly, we will apply the weighted average formula to make calculation of answer. Weight into beta. That is the way we are required to apply the weighted average value. So it is 1.1083 plus 1.1083 Wx, and anything into 0 will become 0. Beta of the portfolio should be 1.20. Accordingly, Wx will be found. So 1.1083 plus 1.1083 Wx plus 0, that does not make a sense, divided by 1.20. So now what will happen? 1.1083 Wx is equal to 1.20 minus 1.1083. So Wx is equal to 1.20 minus 1.1083, that comes to 0.0917 divided by 1.1083. So that comes to 0.0827. Okay. So what happens at, say, in the existing portfolio we will be having, say, the increase in the investment by 8.25, that is 27%. So we understand that, say, 8.27% is the borrowing from risk-free, and so the investment which is supposed to be made in the existing portfolio. So we understand like this. Calculation of investment in existing portfolio, comma, borrowing at risk-free rate of interest. So in that case, again, name of security, that is column number 1, amount, that is column number 2, weight, column number 3, beta, and weight into beta. This is the way we are required to apply the working. So it is VSL, CSL, SML, APL, and risk-free. The amount of the investment which we already have found is 5 lakhs, then it is 1 lakh, then 8,000 into 25, that comes to, I think, 2 lakhs, then 2,000 into 20, that is 200, that comes to 4 lakhs. Now there will be risk-free, and for that it is 8.27%, that is required to be calculated by us. As far as the risk-free security is concerned, it will be calculated like this. 12 lakhs is the overall investment, divided by 1.0827, because 8.27% should be in the risk-free, into 0.0827. So 12 lakhs divided by 1.0827 into 0.0827, that comes to 91,660. This is the borrowing, so it will be shown as negative. So the total will be 11,08,340. This is the way we are required to compute that say what is the amount of the risk-free security that should be brought in. So we are going to borrow and you are going to invest, so that what will happen, risk of the portfolio will increase. So 5 lakhs upon 11 lakh 8,340, 1 lakh upon 11 lakh 8,340, 2 lakhs upon 11 lakh 8,340, 4 lakhs upon 11 lakhs 8,340, and for the last one we already know it is negative 0.0, that is it is required to be kept as balancing figure, so that the total is exactly 1. Accordingly we are required to make the computation of answer. This is what we already know is negative 0.0827. 5 lakhs divided by 11 lakh 8,340. That comes to 0.4511. Divided by 5, 0.0902. 0.1804. 3608. 4511 plus 0902 plus 0.1804 plus 0.3608. So instead of 3608 I make it 3610. Only in that case the total will be exactly 1. Okay. Now respective beta is 0.90, 1, 1.50, 1.20, and it is 0. So 0.4511 into 0.9, that comes to 0.41, 0.406, 0902, 0.2706, 4332. This is of course 0. Exactly it is 1.20. This is the way we can have the cross verification of the answer. That so this is the way we are required to bring the investment in the risk-free security. Basically friends, over here what happens at first thing that we do is that this amount 91660 is the amount that we receive from the existing portfolio. Yes. So 5 divided by 12 into 91660. 1 divided by 12 into 91660. That is the way proportionately we withdraw from the individual security. That amount is withdrawn from the investment. You again borrow the same amount and you make investment in the existing portfolio in the same proportion. So what will happen? We understand that say the risk of the portfolio will increase to 1.2. It means in short, instead of investing the entire 12 lakhs on your own, you borrow an amount and you keep that amount with you. And with that, so the risk of the portfolio will increase to 1.20, as you desire. This is the way the risk of the portfolio can be increased. Question number 5. It is a question from mutual fund. The 5 portfolios experienced the following results during 7 years period. We have been provided with the information wherein portfolio A to portfolio E information is given. The return is given, standard deviation is given, and correlation coefficient is provided to us with market returns. With that said, the standard deviation of the market portfolio is also provided to us. Return on the market portfolio is given and a risk-free rate of return is given. Rank the portfolios using Sharpe method, using Trainer's method, and using Jensen's alpha. So based on these 3 methods, we are required to do the ranking of the portfolios. So first of all, we'll make the calculation of the Sharpe ratio. How to make the calculation of the Sharpe ratio? That's very simple. It is the return from the security minus the risk-free rate of return. That will give us the additional return for making investment in security A or portfolio A, divided by standard deviation of A. So additional return divided by additional risk. Why the term additional risk is used? Because we know that the risk of the risk-free security is 0. So what is the additional return for every 1 unit of additional risk is calculated, and then we do the ranking of the same. Of course, the portfolio which is having the highest Sharpe ratio is considered to be the best portfolio among all. That is the way we are required to do ranking. In case of the Trainer's ratio, we are required to do the same thing. However, in that, instead of standard deviation in denominator, we will take beta in denominator. The third is the alpha, in which we are required to make the computation of the difference between the mean return and the required rate of return. Let us see that one by one how to make the calculation of answer. So first of all, in order to answer question number 5, we'll make the calculation of Sharpe ratio and its ranking. Column number 1 is portfolio. Column number 2 is Sharpe ratio, for which the formula is very simple. X bar minus RF divided by standard deviation. And then finally the rank. Portfolio having the highest Sharpe ratio will be given the first rank, and so on. So let us start with the portfolio A. In that case, what will happen? The return is 19%. Risk-free rate of return is 9% and standard deviation is 2.5. So it is 10 divided by 2.5. So the Sharpe ratio is going to be 4. For B it is 15 minus 9 divided by 2.5. Sorry, divided by 2, because standard deviation is now 2%. So 6 divided by 2, that comes to 3. C portfolio, again 15 minus 9 divided by standard deviation is 0.8. That comes to 7.5. D, in that case it is 17.5 minus 9 divided by 2. So in that case it is 4.25. For E, it is provided as 17.1 minus 9 divided by 1.8. So it is 8.1 divided by 1.8. So it is 4.5. So we are supposed to rank them. So of course the C will be given the first rank. Then it is E 4.5. Then it is D 4.25. Then it is A, and then it is B. This is what we understand is the ranking. And this is the ranking as per the Sharpe ratio. Now we will do the similar ranking, say with the trainers ratio. So next is calculation of trainers ratio and its ranking. Let us see how to do answer. In that again, the column number 1 is portfolio. The second column would be this time beta, because beta is required to be found. It is R into standard deviation of the portfolio divided by standard deviation of market portfolio. Because we can see that the correlation coefficient information is given, standard deviation of each security is given, and standard deviation of the market portfolio is given. So taking into account this three, we are required to make first of all the beta calculation. Once you compute beta, then you will compute the trainers ratio. Trainers ratio will be calculated as X bar minus RF divided by beta, and afterwards we'll give the rank. Security having highest trainers ratio will be given first rank, and that is the way we are required to give rank for the remaining securities or portfolios. So now the beta is calculated as R into standard deviation of the portfolio. R is 0.84. Into standard deviation of the portfolio is 2.5% divided by standard deviation of the market is 1.2%. Next is for B, R is 0.54, R is 0.975, then R is 0.75, R is 0.60. Into standard deviation, standard deviation is 2.8 again to 1.8 divided by the standard deviation of the market portfolio, that is 1.2. That is going to remain of course constant. Now we'll compute the beta. Beta will be found as 0.84 into 2.5 divided by 1.2, that is 1.75. 0.54 into 2 divided by 1.2, that is 0.90. 0.975 into 0.8 upon 1.2, that is 0.65. 0.75 into 2 divided by 1.2, 1.25. 0.6 into 1.8 divided by 1.2, 0.90. When you are getting these nice answers, your confidence increases that I am not committing any mistake. Then the trainer's ratio, x bar minus RF divided by beta. Now trainer's ratio, for security A it is x bar, that is 19%, minus RF is 9%, divided by beta 1.75. For the next security it is 15 minus 9 divided by 0.9. For C it is 15 minus 9 again divided by 0.65. For D for Delhi it is 17.5 minus 9 divided by 1.25. For E it is 17.1 minus again RF 9 divided by 0.9. So 19 minus 9 is 10. 10 divided by 1.75. So 5.7143. 15 minus 9 is 6. 6 upon 0.9 is 6.67. 15 minus 9 is again 6. 6 divided by 0.65. That comes to 9.24. 17.5 minus 9. That is 8.5 divided by 1.25, that is 6.8. 17.10 minus 9, 8.1 divided by 0.9, that is 9. This is the way we are required to make the computation of the trainer's ratio. Now we'll give rank. C portfolio will be given the first rank. The second rank will be given to E portfolio. Third rank will be given to D portfolio. Fourth rank will be given to B portfolio. And fifth rank will be given to A portfolio. This is the way we are required to give ranking to these portfolios. After making the calculation of the trainer's ratio and ranking, the next is the calculation of the Jensen's alpha. So now calculation of alpha. Let us see that how to make the calculation of alpha. Again, name of the security or portfolio. That is column number 1. Next is required return as per CAPM. It is RF plus beta into RM minus RF. Beta we have recently calculated. RF is provided to us in the question. RM is also provided to us in the question. Next is alpha calculation. And lastly, we are supposed to do the ranking. This is the way we are required to make the computation of answer. So, in case of security A, the risk-free rate of return is given to us in the question 9. beta is 1.75. Return on the market portfolio is provided to us as 14%. Minus 9 once again. So based on that, we'll compute the required rate of return. Now, as far as the expected return is concerned, it is 19%. So 19% minus required rate of return. And based on that, so the alpha will be calculated. And then finally, we will do the ranking. So risk-free rate of return is 9%. Beta is 0.9. RM minus RF is going to remain same. Again, this is 9. This is 14 minus 9. This is 9. This is 14 minus 9. This is 9. And this is 14 minus 9. So now what will happen, friends? We'll make the computation of the RM minus RF. 14 minus 9. That comes to 5. 5 into 1.75 is 8.75. Plus 9. That is 17.75. 14 minus 9 is 5. 5 into 0.9 is 4.5. 4.5 plus 9, that comes to 14.5. Again it is 5 into 0.65 is 3.25 plus 9, that comes to 12.25. 5 into 1.25, that comes to 6.25 plus 9, that is 15.25. Again 5 into 0.9, 4.5 plus 9, that comes to 13.5. Okay. Now the mean return is provided to us 19 minus 17.75. That comes to 1.25. That is good performance of the portfolio. Then it is 15 minus 14.5 is again 0.5 positive, good performance. Then again 15 minus 12.25, so it is 3, so it is 2.75. Then for D it is 17.5 minus 15.25, that comes to 2.25. For E it is 17.1 minus 13.5. So difference between both of them is 3.6. That is the way, say we understand that, say we can make the computation of alpha. Security E will have the first rank having highest alpha. Then it is security C. Then it is security D. Then it is security A, and lastly security B. However, all the securities are having positive alpha. It means that, say, the performance of all the portfolios are beating the market performance. It means that, say, the performance is required as per the CAPM expectation. That's really a very good performance. This is the way we have made the computation of the alpha for individual security, and the ranking is done. So ranking of the portfolio using trainers ratio, using Sharpe ratio and alpha. So now we have a small summary. Column number 1 is rank, that is 1, 2, 3, 4 and 5. As per Sharpe ratio, as per trainers ratio, and as per Jensen's alpha. So here is the ranking as per the Sharpe ratio. In that we understand it is C, then it is E, then it is D, then it is A and B. CED AB, CED A and B. This is the ranking as per the Sharpe ratio. Based on the trainers ratio, the ranking is like this. It is again C, then it is E, D, B and A. So it is CE, DBA. And lastly, as per the Jensen's alpha, it is E, then C, D, A, B. So E, C, D and A, B. E, C, D and A, B. This is what's the ranking that we have, say, as per the Sharpe ratio, as per trainers ratio and as per Jensen's alpha. Friends, over here there is a small correction in the calculation. 14 minus 9, 5 into 0.9, 4.5 plus 9, that comes to 13.5. As it is 13.5, so this becomes 1.5. And because of that, so there is a change in the ranking. This will become 4 and this will become 5. Okay. So over here it is B and A once again. This is what's the portfolio ranking, say, based on the different methods: Sharpe ratio, traders ratio and that is Jensen's alpha. Question number 6. A company is long on 10 metric ton copper at the rate of 534 rupees per kg spot and intends to remain so for ensuing quarter. The variance of the changes in its spot and the future prices is 16% and 36% respectively. So the variance information is given. Having correlation coefficient of 0.75, that is R is 0.75. The contract size for one contract is 1000 kg. Calculate the optimum hedge ratio for perfect hedging in the futures market. So we are required to make the computation of the hedge ratio. So dear students, we can make the computation of the answer like this. Answer for question number 6. We understand that the hedge ratio is equal to R into standard deviation of spot divided by standard deviation of futures. This is a simple formula to be applied. R, that is correlation coefficient, which is provided as 0.75 into standard deviation of spot. So it is under root of 16 divided by standard deviation of futures, that is it is under root of 36. So 0.75 into 4 divided by root of 36 is 6. So 4 divided by 6 into 0.75. That is the way we are required to make the computation of answer. So 0.75 into 4 divided by 6. That comes to 0.50. This is what's the hedge ratio that we have. Advise the position to be taken in futures market for perfect hedging. It's very simple. You have the long position right now with you in the spot market. So for the purpose of hedging, you have to take short position. So the answer for the second part of the question, in that we understand enter in short position in futures market comma for the purpose of hedging. That is what we understand. Third is determine the number and the amount of the copper futures to achieve a perfect hedge. So, what is the quantity and what is the amount for which the futures contract is to be entered upon? That is a question. So, we understand that say the futures contract to be entered upon. In respect of the quantity and in respect of the value. So, number of contracts will be calculated like this. Hedge ratio into 10 metric ton because you are long on 10 metric ton divided by lot size. What is hedge ratio? It is 0.5 into 10 into 1000 kg. 1 metric ton is equal to 1000 kg divided by 1000 kg. So with that the answer comes to 5 contracts. And so we'll make the computation of this answer in terms of amount. We can see that so the value is provided to us 534 rupees per kg. So we understand that say 1000 kg, that is the lot size, multiplied with the number of contracts, that is like 5 into price. The amount of the price is given 534. ₹26,70,000. This is the amount for which so the futures contract will be entered upon. Question number 7. Details about the portfolio of the shares of an investor is as below. There are 3 securities for which information is given. Number of shares are given to us. Price per share is given to us. So product of both of them will give the value of the investment. Respective beta is given to us. The investor thinks that risk of the portfolio is very high and wants to reduce the portfolio beta to 0.91. He is considering two below mentioned alternative strategies: dispose of part of his existing portfolio and acquire risk-free security, or take appropriate position on Nifty futures which are currently traded at 8125 and each Nifty point is worth rupees 200. You are required to determine the beta of the portfolio, value of the risk-free security to be acquired, number of shares of the each company to be disposed of, and so on. Further questions are given to us. So let us solve the question one by one and then we'll understand it. That is the entire question. The first question is, what is the beta of the portfolio? So we will compute the value of the investment, we'll compute the proportion, we'll multiply the same with the beta, and with that, so the beta of the portfolio will be calculated. Answer for question number 7. In that, first of all, answer for the A part of the question. Calculation of beta of portfolio. In that, column number 1 is name of the security. Column number 2 is value. Third column is weight or proportion. Next is beta, weight into beta. That is the way the beta of the portfolio is calculated. That is the first question answer. So now name of the security. In that, A, number of equity shares are 3 lakhs. Market price of the share is 500. So it is 1500 lakhs. In case of B, it is 4 lakh number of shares into 750, that comes to 3000 lakhs. For C, it is 2 lakh into 250, that comes to 500 lakhs. So 1500 plus 3000, that comes to 4500. 4500 plus 500, that comes to 5000 lakhs. That is the way we compute that. So what is the overall value of the portfolio? Then we'll compute the weight or proportion, in which we understand that, so the 1500 lakhs in A out of 5000 lakhs. So weight or proportion is 0.30. 3000 lakhs in B, again out of 5000 lakhs. So it is 60% is in B and 500 lakhs in C, again out of 5000 lakhs. That comes to 0.10. So 361, the total is 1. Multiplying with the respective beta, 1.4, 1.2 and 1.61. This is the way the weighted average value will be found, and that is the beta of the portfolio. So 0.3 into 1.2, that is 0.42. 0.6 into 1.2, 0.72. 0.10 into 1.6. And based on that, so the beta of the portfolio is calculated. So 0.42 plus 1.72 plus, I'm sorry, plus 0.16, that comes to 1.30. So what is the beta of the portfolio? It is 1.30. Okay. Now the second part of the question says that, what is the value of the discrete security to be acquired? Now basically in the question it says that dispose of a part of the existing portfolio to acquire the discrete security. So what is the proportion of the investment to be, say, disposed of, and for that the discrete security to be acquired? That is the question. So answer for the B part of the question. We can say that's the second part of the question. In that, say we are required to make the calculation of answer. So answer for the second part of the question, in which value of risk-free security to be purchased. In that, say we will work out the answer like this. Beta of the portfolio is beta of existing portfolio into weight of existing portfolio. Beta of risk-free security into weight of existing security. What is the beta? 0.91. What is the beta for existing one? 1.30 into weight of existing. 0 into weight of RF. Now anything into 0 will become 0. So now weight of existing will be calculated as 0.91 divided by 1.30. So for that the answer comes to 0.70. What does it mean? You have to keep the 70% of the investment in the existing portfolio and 30% is required to be transferred to risk-free security. With paragraph write down. Based on above working, comma, we can conclude that 30% of investment should be diverted into risk-free security. Full stop. Now what is the value of your existing investment? 5,000 lakhs. Amount of risk-free security to be purchased is rupees 1,500 lakhs. That is 5,000 lakhs into 30%. Third question. What is the number of shares of each company to be disposed of? Now friends, whatever the investment that we have made in these three securities right now, of that 30% will be calculated. And 30% of that is the amount to be disposed of, say from each of the investment. Whatever the amount that say we want to receive, that is equal to the 30% of the value divided by P0, that is 500, 750 and 250. That is say with the number of shares to be sold will be calculated. So answer for the C part of the question. Number of shares to be sold. Security A, security B and security C. Amount P0 and number of shares. P0 is 500, then 750, then 250. This is the price per share. And in the column of amount, this value 1500 into 30 percentage, then 3000 into 30 percentage, and 500 into 30 percentage. So as far as the security A is concerned, it is 1500 into 0.3. Security B is concerned, it is 3000 into 0.3. And for security C, it is 500 into 0.3. This is the amount. So 30% of 1500 comes to 450 lakhs. 30% of 3000 comes to 900 lakhs. 30% of 500 comes to 150 lakhs. That gives us the amount divided by P0. So what will happen? 450 lakhs divided by 500. So that comes to 0.9 lakh, that is 90,000 shares. Next is 900 lakhs divided by 750. So the answer comes to 1,20,000. Next is 150 lakhs divided by 250. 0.6 lakh, that is 60,000. So this is the way we can compute that, say what is the number of shares to be sold off for each of the security. Next, D question. The question speaks that what is the number of Nifty futures contract to be bought or sold? Because in order to reduce the risk, the next action that you are considering is to enter into the index transaction. So friends, you are having such a long position in the cash market. In order to reduce risk, you will take the short position in the futures market. So answer for the D question. In that we understand number of futures contract to be sold for the purpose of hedging. Friends, it will be calculated like this: value of the portfolio into beta of the portfolio minus beta required whole divided by futures index value into lot size. That is the way we are required to make the calculation of answer. What is the value of the portfolio that say we have right now? Right now we have a value of the portfolio of 5,000 lakhs. What is the beta right now? 1.30. What is required beta? 0.91. Divided by futures index value is 8125 and lot size is 200. This is 8125 and this is 200. So like this we'll compute that's the number of contracts to be sold. So 8125 into 200, that is 16,25,000. As far as the numerator is concerned, it is 1.3 minus 0.91. That comes to 0.39 into 5,000 lakhs. That comes to 195, 123, 456. 19 crore 50 lakhs divided by 16,25,000. and the answer comes to 120 contracts. So by entering into the transaction for sale index future for 120 contracts, you will be able to have the hedging and risk of your portfolio reduces to 0.91. What is the portfolio beta for 2% rise in Nifty? So answer for the E part of the question. Calculation of beta of portfolio, comma, if Nifty increase by 2%. So in this case, how to make the computation of the beta of the portfolio? Let us understand. Working note number 1, calculation of percentage change in value of securities, comma, with percentage change in RM. So with the change in the return on the market portfolio, what is the change in the return of the securities required to be found? Beta measures percentage change in RJ upon percentage change in RM. So percentage change in RJ is equal to beta into percentage change in RM. What is beta? 1.3. What is percentage change in RJ? Sorry, RM? That is 2%. Because the question is giving the information that the return on the market portfolio increases by 2%. So 1.3 into 2%, that comes to 2.6%. So there is an increase in the return of the security by 2.6%. Working note number 2, calculation of overall profit or loss with change in RM and change in return from portfolio. So market and portfolio, for both of them we are required to make such changes calculation. So now we will make the computation like this. We understand that the sale value purchase value, based on that the profit or loss will be calculated. We understand that it is the futures index value is 8125 and the lot size is 200 and 120 contracts are sold. So 8125 into 200 into 120 contracts. This is a sale value, say for the transaction in which you have entered upon in Nifty. 8125 into 200 into 120. That comes to 1950 lakhs. The question is providing the information that there is a 2% rise in the Nifty. So purchase value will be 1950 plus 2%. So it is 1989. Difference between both of them is the loss, that is 39 lakhs. Okay. Now as far as the portfolio in which you have made investment, for that we understand value of the portfolio is 5000 lakhs. With the increase in the market portfolio return, value of your portfolio will also increase by 2.6 percentage. So 5000 plus 2.6 percentage, a kind of deemed sale value, that is 5130 lakhs. Difference between both of them is 130 lakhs, and that is the profit that you have. So overall profit or loss, let us see. So 130 minus 39, that comes to 91 lakhs. This is the way the overall profit can be calculated. Now percentage return is income upon investment in 200. So income of 91 lakhs on investment of 5000 lakhs, that is the way the income will be found, and it is 1.82 percentage. The question says that, say, what is the portfolio beta? Now here is the point at which you will give the final answer, and this is very important. Beta is percentage change in RJ divided by percentage change in RM. Return from the overall portfolio is 1.82% positive when return on the market is 2%. So it comes to 0.91. And this is the way the beta is supposed to be calculated. And this is a way you can have even the cross verification for the answer that we have computed in the fourth part of the question. So let us have the overall summary of the entire answer. The first question says that say compute beta of the portfolio. In that, say what we will do, the proportion in which we have made investment multiplied with beta, that is beta of the portfolio. Second question, value of the risk-free security to be purchased. In a way that say we understand that say a certain portion of the existing investment will be sold and we will purchase a risk-free security in place of the same. Beta of the portfolio is simple weighted average. So what would be the weight of existing security so that beta of the portfolio is 0.91? It comes to 0.70. So out of 5000 lakhs, 30% investment is supposed to be made in risk-free security, that is 1500 lakhs. So that 1500 lakhs we will be able to achieve by selling existing investment. And importantly, in that we have to make sure that we dispose of the investment exactly in the same proportion in which we have made investment right now, that is 30. So in that case it is like 1500 lakhs into 30%, 3000 lakhs into 30%, and 500 lakhs into 30%. So you can see that the total of that also is exactly 1500. Once we compute the amount divided by price, that will give us the number of shares. So it is 90,000, 1,20,000 and 60,000. That is the number of shares to be disposed of. Next question is number of futures contract to be sold for the purpose of perfect hedging. That is the question. So in that case, so value of the portfolio into beta of portfolio minus beta required divided by index value into lot size. That gives us the answer of 120 contracts to be sold. Now key question is an excellent question. The question says that if at all you do as what you have suggested in the fourth part of the question, Compute beta of the portfolio if market increases by 2%. So if at all the market increases by 2%, then in that case, for your short position in index, or we can say that in market portfolio, you will incur a loss. However, say in your own portfolio, you will make a gain. Why? Because say the market will increase by 2.6%. When there is say an increase in the, that is market by 2%, that is your own portfolio will increase by 2.6%. So this is the gain that you have. Overall there is a gain of 91 lakhs divided by 5000 lakhs into 100, so it comes to 1.82%. And with that, so we can compute the beta of the portfolio, 0.91. Question number 8, next question. Your bank's London office has surplus funds to the extent of 5 lakh US dollar for a period of 3 months. So the amount is 5 lakhs dollar and the time period for which you have the excess funds is 3 months. The cost of funds to the bank is 4% per annum. It proposes to invest these funds in London, New York or Frankfurt and obtain the best yield without any exchange risk to the bank. The following rates of interest are available at the 3 centers for investment of the domestic funds there for a period of 3 months. London, it is 5%, that is in pound currency. New York, it is 8%, that is dollar currency. Frankfurt, it is 3%, that is euro currency. The market rates in London for United States dollar, in London for euro are as under. So the rates are provided London or New York. So the spot exchange rate is provided to us 1.5350 slash 1.5390 dollar per pound. For 1 month, 2 months and 3 months, forward points, swap points are given. London and Frankfurt, that is we have been provided with the exchange rate for euro per pound. Spot 1 month forward, 2 month forward and 3 month forward. At which center investment will be made and what will be the net gain, that is a question, to the nearest pound. So we are required to give the final answer in pound currency term. To the bank on the invested funds, that is a question. So over here, so we are required to make the computation that what would be the net gain, so for the investment made in pound currency, that is a question. So friends, over here we are required to make the computation of the net gain calculated in pound currency term if at all we are making investment in each of the currencies. So let us now start with the calculation that say if at all we make investment in pound currency, then what is the amount of the net gain that we have? So heading is calculation of net gain for investment in pound currency. Let us see that say how we are required to make the calculation of answer. First of all, a simple working note that say what is the repayment of the loan. Working note number 1, calculation of repayment of loan. Dear students, we can see that say over here information is given that say we have an amount of surplus funds to the extent of 5 lakh dollar and the cost of the same to the bank is 4%. So in that case it will be principal plus interest (5 lakh plus 5 lakhs) into rate of interest is provided to us 0.04 into 3 divided by 12. So 5 lakhs into 1.01 . 0.04 into 3 divided by 12. So it comes to 5,05,000 US dollar. Okay. Next is working note number 2. Calculation of repayment of loan in pound currency. Sir, why do we make computation in pound currency? The reason for that is very simple. We are making the calculation in pound currency because we want to have the net gain to be computed in pound currency. So now you can see that the spot exchange rate is provided to us as dollar per pound. This 1 month information is of no use to us. 2 months information is of no use to us. This 3 months information is useful to us. Spot exchange rate is 1.5350 slash 1.5390. 8085. This is 80 and this is 85. 3 months forward points or swap points. It is low high, yes, so it is to be added to spot exchange rate. So 1.5430 slash 1.5475. This is dollar per pound. Forward contract will mean sell of pound and purchase of dollar. This is the amount of the pound to be sold for purchasing $5,05,000. Sell pound and purchase dollar, we will get less amount of dollar. $1.5430 is equal to 1 pound. So $5,05,000 is equal to this amount of pound. 5,05,000 into 1 divided by 1.5430. So the final answer is 3,27,284.51. This is the amount of the amount that you have to pay. So calculation of net gain in pound currency. Amount received minus repayment of loan. Okay. Now what is the amount that you will receive? Let us see. Dear students, this is the spot exchange rate. Where did we understand it is sell of dollar and purchase of pound? Because conversion of the dollar into pound, this is the rate that would be applicable. 5 lakhs divided by 1.5390. Now when you are making investment in pound currency, then the rate of interest is 5%. So into 1.0125. 0.05 into 3 divided by 12. This is the maturity amount of deposit minus repayment of loan 3,27,284.51. This is the way the net gain is supposed to be calculated in pound currency term. So kindly use a calculator. 5 lakhs divided by 1.5390, that comes to 3,24,886 into, sorry, 0.29 into 1.0125. This is the maturity amount of deposit minus 3,27,284.51. So the maturity amount is 3,28,947.37 minus 3,27,284.51. So the final answer is 1662.86. This is the amount of the net gain that you will have if at all you invest in pound currency. I just repeat my calculation. First of all, we make the computation of the repayment of loan in dollar currency. Then we make the computation that say what would be its value in pound currency. Since we are required to compute the net gain in pound currency, then the net gain in pound currency is found like this: the amount received, so maturity. For that, say amount of dollar divided by exchange rate, that will give the amount of the pound which we have invested in pound, then multiplied with the exchange rate, that will, that is true that the interest is added, so we get the maturity amount of deposit minus repayment of the loan. Repayment of the loan is simple, principal plus interest. This is the way net gain is calculated in pound currency term. Next, after making this calculation, the next alternative is that we invest in dollar currency. So heading right down, option number 2, invest in dollar currency. So if at all you make investment in dollar currency, then what will happen? Let us see. Calculation of net gain in pound currency. It is interest income minus interest expense divided by exchange rate. See, as per the given information, you get interest income at 8% and your interest cost is 4%. So 5 lakhs into 0.08 minus 0.04 into 3 divided by 12 divided by whatever the net gain that you have, so that is in the dollar currency, so that is required to be converted into pound currency. So sell of dollar and purchase of pound, and for that, so this is the rate that would be applicable, 1.5475. So 5 lakhs into 4% into 3 real petrol, that comes to 5,000 divided by 1.5475. So 3,231.02. This is the amount of the net gain that you have in pound currency. Alternative 3, you make investment in euro. So if at all you invest in euro, then what will happen? Let us see. Working note number 1, calculation of investment in euro. First of all, we are required to convert the dollar into pound, then pound into euro. That is the way first of all we are required to do conversion. So what is the amount that we will invest in euro currency? For that we are required to use the spot rates, dollar per pound and euro per pound. So 1.5350 slash 1.5390, it is dollar per pound, and 1.8260 slash 1.8290, it is euro per pound. That is the way we are required to make the computation of the investment in that is euro. We have to compute euro per dollar. So what is the amount of the euro per dollar is required to be calculated? Euro is final answer per dollar. Against dollar, pound is given. Against pound, euro is given. I want euro per pound. So 1.8260 slash 1.8290 euro per pound. I want pound per dollar, but dollar per pound is given, so we have to make a reciprocal. 1 divided by 1.5390 slash 1 divided by 1.5350 pound per dollar. So 1.8260 into 1 does not make a sense, divided by 1.5390. So 1.1865. 1.8290 divided by 1.5350. So 1.1915. It is euro per dollar. Okay. So now we want to make the investment in euro currency. So for every $1, you will get less amount of euro. 1.1865 into 5 lakhs. So 5,93,250. This is the amount of the euro that we will invest. Working note number 2. Calculation of maturity amount of deposit in euro currency. In that case, it is investment plus interest. What is the investment? This is the investment. 5,93,250. Euro currency rate of interest is given to us in the question as 3%. So 1.0075. Again, we understand that say it is 0.03 into 3 divided by 12. So 5,97,699.375 euro. This is the maturity amount of the deposit in euro currency. Working note number 3. Calculation of forward exchange rate for euro per pound in 3 months. For that, so this is what the information to be used. As it is high-low, it will be deducted from spot exchange rate. Spot is 1.8260 slash 1.8290. 3 months. 145, 140. It is high-low, so it will be deducted. So 1.8260 minus 0.0145. So 1.8115. One point eight two nine zero minus 0.0140. 1.8150. It is euro per pound. Calculation of net gain, once again in pound currency. That is maturity amount minus the repayment of loan. Now what happens at, so this is the maturity amount of the deposit that we have in the euro currency. 597 699.375 divided by, for a higher amount of the euro you will get a pound, 1.8150 minus repayment of the loan. We already have calculated the repayment of the loan in pound currency. This is the repayment of the loan in pound currency. 327,284.51. 3,27,284.51. So 597 699.375 divided by 1.8150 That comes to 3,29,310.95 minus 3,27,284.51. So that comes to 2026.44. This is the amount of the net gain that you have in pound currency. So now you are required to make the comparison. Investment in pound, investment in dollar, investment in euro. Net gain is 2026.44. Then 3231.02. And for pound it is 1662.86. So this is the way we have a kind of net gain for each of the option. Of course, we understand that we are required to select an alternative which is able to make which is able to give us the net, that is maximum gain, and that is what we understand is the dollar currency. So we should invest in dollar currency. Let us have a final summary. We have borrowed an amount of 5 lakhs US dollar at the rate of 4% for a time period of 3 months. We are having set the 3 alternatives of making investment. The question is providing the information that we are required to make net gain in the pound currency. So what we are doing, say first of all we are making the computation of the simple, that what will be the net gain, say if at all the investment is made in pound currency. In that, the first working note is calculation of the repayment of loan in dollar currency, then calculation of the repayment of loan in pound currency, and then the net gain in pound currency. In that, so the investment that we are going to make today is converted into UK pound. You are making investment in pound, so you get this amount of the maturity, and from that the repayment of the loan will be deducted in pound currency, which we have calculated say in the previous working. So this is the net gain. Option number 2 is very simple. You invest in dollar currency. You already have borrowed in dollar currency at the rate of 4%, and you are investing once again in dollar currency at the rate of 8%. So difference of that is the 4% is the gain that you have, and this amount of the gain is converted into pound currency, so using the forward exchange rate of dollar per pound. That is the second alternative. The third alternative is say investment in euro. So euro is converted to dollar and dollar is converted into pound. So the dollar is converted to pound, dollar is converted to pound, and then pound is converted to euro. That is the way. So first of all you make investment in euro. Whatever the maturity amount of the deposit that say you have in euro currency is converted back into UK pound. So we have made the computation that say what is the amount that say we will be having say in pound currency at the end of the 3 months. Whatever the loan that we already have taken, that its repayment of the loan in dollar currency and in pound currency has already been found by us. So this is the repayment in pound currency. That is the way the net gain is calculated, and you make a comparison. So based on this, we understand that say we take a decision of making investment in dollar currency. So the decision is invest in dollar. Question number 9. XYZ Limited has imported goods to the extent of 8 million US dollar. The payment terms are as under 1% discount if full amount is paid immediately. 60 days interest free credit. However, in case of further delay up to 30 days, rate of interest 8% per annum will be charged for additional 30, that is additional days after 30 days. Mrs. XYZ Limited has rupees 25 lakhs available, and for the remaining amount it has an offer from the bank for a loan up to 90 days at the rate of 99% interest per annum. The quotations for the foreign exchange rates are as under. Spot rate is given, 60 days forward exchange rate is given to us, 90 days forward exchange rate is given to us. Advise one of the following options would be better for the company. Pay immediately after utilizing the cash available, and for the balance amount take 90 days loan from the bank. Pay supplier on 60th day and avail the loan after utilizing the cash for 30 days. Avail the supplier's offer for 90 days credit and utilize the cash available. Further, presume that the cash available with XYZ will fetch a return of 4% per annum in India till it is utilized. So that information will be useful for second and third alternative. Assume 360 days in a year and you know Texas. Computer working up to 4 decimals, and cash flows are required to be made in crores of rupees. That is the way the information is given. That's the figures are required to be computed in crores of rupees. So let us start with the answer. Alternative number 1. In that, pay immediately after utilizing the cash available, and for the balance amount take loan. So in that we are required to, that is, prepare a few working notes like this. Working note number 1, calculation of amount payable. The amount of the consideration is 8 million. 1 million is equal to 10 lakhs. So 8 million is equal to 80 lakhs. So consideration minus discount. So 80 lakhs minus 80 lakhs into 1%. So 80 lakhs minus 80,000. That comes to 79 lakh 20,000. So this is what's a working note number 1, consideration which is supposed to be paid. Now the spot exchange rate is given 66.98. So working note number 2, calculation of amount of borrowing. In that, amount to be paid minus amount available. So it is 79 lakh 20,000 into the exchange rate is 66.98 minus the amount available, that is an amount of 25 lakhs. The question speaks that we are required to make the computation into 4 decimals and the amount is required to be found in crores of rupees. So we can say something like this: 79 lakh 20,000 multiplying with 66.98. This is the amount minus 25 lakhs. So the amount comes to 53 crore 4 lakh 81,600 minus you have 25 lakhs. So the amount that you need to borrow is 52 crore 79 lakh 81,600. So it comes to 52.7982 crore. 816, so I make it 82 because the question is clearly providing that say we are required to convert this say into crores of rupees. So divided by 1 crore. Okay. So this is the amount of the borrowing. So next is calculation of total cost that is required to be found over here. That is calculation of, we can say that's the repayment of loan. After 90 days. Let us see that so what will be the amount of the repayment of loan after 90 days. So it is 52.7982 plus 52.7982 into rate of interest. What is the rate of interest? The rate of interest is 9%. 0.09 into time period is 90 days. Because we will borrow this amount for 90 days. So 52.7982 plus 1.1880. So 53.9862. So this is the amount of the loan which is supposed to be repaid in the first alternative. Alternative number 2. Pay supplier on 60th day. And avail bank loan after utilizing cash for 30 days. Okay. So now in this case we understand there will not be any discount advantage that we will have. The amount that we have to pay will be an amount of 8 million. This is the amount to be paid. We understand that say we are going to make the payment at the exchange rate of 67.16. This amount of 25 lakhs will be invested at the rate of 4% and that will be invested for a time period of 60 days. The remaining that is then the remaining amount will be borrowed for the purpose of making payment and that will be borrowed at the rate of 9% for 30 days. Let us execute the answer. Working note number 1, calculation of maturity amount of deposit of rupees 25 lakhs, comma, after 60 days at the rate of 4%. It is principal plus interest. 25 lakhs plus 25 lakhs into 4% into 60 divided by 360. So in that case it is 25 lakh 16,667. This is the maturity amount of deposit at the end of the 60 days. Working note number 2, calculation of amount to be borrowed after 60 days, comma, to make payment to supplier. So it will be calculated like this: amount payable minus amount available. As far as the amount payable is 80 lakhs into the exchange rate, that is forward exchange rate is 67.16 minus 25 lakh 16,667. It comes to 53 crore 47 lakh 63,333. This is the amount which is supposed to be borrowed at the end of the 60 days for 30 days. Because we understand at say 80 lakhs into exchange rate, this is the amount that say we are supposed to pay. whatever the amount of 25 lakhs that say we had at the beginning of the period is invested for 60 days, and this is the maturity amount at the end of the 60 days. Difference of both of them is the amount that say we have to borrow for the purpose of making payment to the supplier. So based on that working note number 3, calculation of repayment of loan. It is principal plus interest. 53 crore 47 lakhs 63,333 plus 53 crore 47 lakhs 63,333 into rate of interest is provided to us in the example as 9%, 0.09 into 30 divided by 360. So into 9% divided by 12. So 53 crore 47 lakhs 63,333 plus 40 lakh 10,725. Friends, the entire answer is divided by 1 crore because we are required to write the answer in crores of rupees, and that up to 4 decimal. So 53.8447, 8774, I'm sorry. This is the amount which is payable, say, at the end of the period in second alternative. Alternative number 3. In that, avail supplier offer of 90 days credit and utilize cash available. Let us see that, say, in this case how we are required to make the computation of answer. So in this case, working note number 1, calculation of amount payable in rupees term and maturity amount again in rupees term. So let us see that, say, how to make the computation of answer. So over here it is 80 lakhs plus 80 lakhs into they will charge interest at the rate of 8% into 30 divided by 360. This is the amount payable in dollar currency at the end of the 90 days. This is the exchange rate applicable for the purpose of making payment of consideration 68.03 minus 25 lakhs plus 25 lakhs into 4% into 90 divided by 360. Whatever the answer that say we get is required to be converted into crores of rupees. So now it is 80 lakhs into 8% into 30 divided by 360. That comes to 53,333 plus 80 lakhs. That is 80 lakh 53,333 into 68.03. That comes to an amount of 54 crore 78 lakhs 68,266.67 minus 25 lakhs into 4% into 90 divided by 360. That comes to 25,000. So minus 25 lakh 25,000. Whatever the answer that we have will be divided by 1 crore. So 54 crore 78 lakh 68,266.67 minus 25 lakh 25,000. This amount divided by 1 crore. 54.5343 crore. This is the way we are required to make the computation of the amount to be paid at the end of the 90 days. So let us have the summary of the entire answer. The first alternative is that we pay immediately. In that case, what will happen? So the first thing is that we will get the advantage of the discount, and at the same time, we will be able to use the 25 lakhs which we have right now. So it is 80 lakhs minus 1%, that comes to 79 lakh 20,000 into spot exchange rate. Product of both of them is the amount which is payable right now minus 25 lakhs which we have in our pocket which we pay. That amount divided by 1 crore, so will give the amount of the value in crores of rupees. Then, so for this amount we assume that we are taking loan as per the given information, for which the rate of interest is 9%. So we get the repayment of the loan in rupees term. That is the first alternative. Second alternative is that we make payment after 60 days. In that case, the discount advantage will not be there. So 80 lakhs into exchange rate, that is the amount that we have to pay at the end of the 80 days. This 25 lakh rupees which we have right now, that we will invest for 60 days and we will get some maturity amount of the deposit. So whatever the maturity amount of the deposit will be deducted from the amount payable, and this is the net amount for which we have to borrow funds for 30 days, again as per the given information. So automatically what happens at all the options will become comparable at the end of the 90 days. So this is the amount which we are required to pay at the end of the 90 days. The third alternative is that we avail the credit from the supplier itself for 90 days period. In that case, what will happen? So the principal plus interest. Why? Because we understand that the supplier is demanding in that case the interest at the rate of 8% into exchange rate at the end of the 90 days. This is the amount that we are required to pay to the supplier. This is indicating the amount which we require to pay to the supplier. Minus, so the amount that say we have to pay is, say, the principal plus interest. That is this amount which we have, that will be invested this time for 90 days. Difference of that divided by 1 crore is the amount payable at the end of the 90 days. These three alternatives are compared, and the alternative which is having, say, the least cost will be selected. This is the way we are required to give answer. So first alternative, second alternative, and third alternative. The questions have been formed in such a way so all of them will become comparable. In over here in first alternative we make payment today. In second alternative we make payment on 60th day, and in third alternative we make payment on 90th day. And we get the amount which is comparable, and we select an alternative which is having the least cost, 54.5343. In case of the second, 53.8774. And as far as the first alternative is concerned, it is 53.9862. So making a comparison of all of them, we understand that the 60th day would be the best alternative. So the final answer is the amount should be paid after 60 days. This is the way we are required to write answer. Question number 10. A United States of America based company is planning to set up a software development unit in India. Software developed at the Indian unit will be bought back by the US parent at a transfer price of $10 million. The unit will remain in existence in India for 1 year. The software is expected to be developed within this time frame. The United States based company will be subject to corporate tax of 30% and withholding tax of 10% in India, and will be eligible for tax credit in India. The software developed will be sold in the United States market, and many companies are ready to acquire the same. Other estimates are as under: rent for a fully furnished unit with necessary hardware in India is 18,75,000. Manpower cost 500 rupees per man hour. 80 software professionals will be required for 10 hours per day. Administration and other costs an amount of 15 lakhs. Advise the US company and the minimum amount it should charge from the prospective buyer. The rupee dollar rate is 60 rupees per dollar. Assume that there are 365 days in a year. This is the question. So dear students, over here we understand that the exchange rate of 60 rupees per dollar will be applicable for the purpose of conversion of the foreign currency into domestic currency. So the price is $10 million. That is what we are going to receive. So $10 million into exchange rate, that will give us the amount that will be received by the Indian unit, that is Indian subsidiary. Next we understand is that there are certain expenses in form of the rent, in form of the employee cost, in form of administration cost. Total of all of them will become the total cost. That is the way we are required to make the calculation. So let us start with the working. Answer for question number 10, I suppose, yes. In that, working note number 1, calculation of the total cost. So we'll make the calculation of answer in this way. Column number 1 is particulars and column number 2 is amount. There is an expense of rent, that is 18,75,000. Next is the manpower cost. It is 80 professionals are working for 10 hours a day. So it is 800 number of hours into 365. This is the number of hours in a year into 500 rupees per hour. So 80 into 10 into 365 into 500. That comes to 14 crore 60 lakhs. That is the manpower cost. Administration and other cost 15 lakhs. So these are the expenses that we have. Based on this, so the total cost will be calculated. So 14 crore 60 lakhs plus 15 lakhs plus 18 lakh 75,000. So it comes to 14 crore 93 lakhs 75,000. This is the way the total cost can be calculated. Working note number 2, calculation of amount to be repatriated to United States of America. So in that we'll write first of all the revenue. See, the consideration is provided to us as an amount of $10 million and the exchange rate is provided as 60. $1 million is equal to 10 lakhs, 10 million is equal to 100 lakhs into 60. That comes to 6,000 lakhs. Less expenses. That comes to 1493.75 lakhs. Profit before taxes 4506.25 lakhs. Profit after taxes. Income tax rate is given to us in the question as 30%. So we can say that the tax liability is at the rate of 30%. 1351.875 lakhs. Profit after taxes is remaining 70%. 3154.375 lakhs. Less withholding tax that is at the rate of 10 percentage. So 315.4375 lakhs. So this is the amount of repatriation. It comes to 2838.9375 lakhs. So 3154.375 minus 315.4375. So 2838.9375 lakhs. This is the amount that will be repatriated over there. This is in rupees term, and the same answer can be calculated in dollar currency term. 2838.9375 divided by 60. That comes to 47.315625. This is the lakhs of dollar for which repatriation will be there back to the US company. Because US company basically had made the payment of 100 lakhs, but whatever the amount which is remaining surplus in the Indian unit, that will be paid back over there. That is an amount of like 47.315625 lakhs. This is what we understand. So now friends, what happens at say the question says that say advise a US company the minimum amount it should charge from the prospective buyer. That is the question. So dear students, over here if at all we go completely logically, it is like this. This is the amount that say the US company has paid. Yes. This is the amount that say it is receiving back. Yes. So difference of both of them is the cost. So we understand that say minimum price at which software to be sold in US market. It is 100 lakhs minus 47.315625. So difference between both of them comes to 52.684375 lakhs dollar. This is the minimum price. Or otherwise, a student can make calculation in this way also. It is the cost divided by exchange rate. From the US company point of view, the cost is consisting of this amount 14 crore 93 lakhs 50,000. Sorry, 14 crore 93 lakhs 75,000. Plus payment of income tax. This is the amount of tax 1351.875 lakhs. So 1351.875 lakhs plus the amount of the withholding tax 315 0.4375 lakhs. 3 crore 15 lakhs, 43,750. Whole divided by exchange rate is 60. So 1493,75,000 plus 1351,875,000 plus 3154,750 whole divided by 60. That comes to dollar 47,95,287.5. So there is a calculation error on my end. First of all, we make the total of this 3 and that comes to 31 crore 61 lakhs 6,250 divided by exchange rate 60. So it comes to 52.684375 crore 4375 lakhs, and this is of course in the dollar currency. This is the minimum price at which you should sell over there. That is what we understand. Let us have just a review of the entire answer. Basically, this question is required to be solved from the US company point of view. The US company is coming in India for development of a software. Whatever the software which is developed will have a cost of developing 14 crore 93 lakh 75,000. Now, this amount of the cost is there in Indian unit, that is Indian subsidiary. They are going to pay the consideration of 100 lakhs of dollar. So 100 lakhs into 60. This is the amount of the revenue which they are going to receive. That is the Indian unit. Minus the cost, that will give us the profit. Minus income tax will give the profit after taxes. Minus withholding tax will give the amount to be repatriated, which is converted into dollar currency. Now the minimum price at which the software to be sold in the US market. For that, say one is the logical working that I paid 100 lakhs and I receive back 47.315625 lakhs. So difference of that is a kind of deemed cost which I am incurring. Or otherwise, whatever the cost in rupees term divided by exchange rate. Rupees term cost is consisting of the rent, then manpower cost, administration cost, income tax and withholding tax. Total of all of them divided by exchange rate will give the minimum price. Question number 11. Derivative bank entered into a swap. Swap means interchange agreement on a principal of 10 crore and agreed to receive Manpower overnight floating rate for a fixed payment on the principal. The swap, that is interchange, was entered on Monday 19th of August 2019 and was to commence on 20th of August 2019 and it will run for a period of 7 days. Respective MIBOR rates for Tuesday to Monday were as under. So for Tuesday, for Wednesday, for Thursday, for Friday, for Saturday and for Sunday, then Monday. The fixed rate of interest is 8%. Then evaluate the nature of this swap arrangement and the second is so the net settlement amount. Because both rate of interest have been given to us, fixed and the floating. Note that so the Sunday is a holiday. That is the reason say for Sunday no separate rate of interest is provided to us. Work in rounded of rupees and avoid decimal working. Consider that so there are 365 days in a year. Friends, over here, so this is given name as the plain vanilla overnight index swap. That is what its name is. Vanilla is a flavor which does not have say any like the essence to it. So it is vanilla stands for the simple. So plain vanilla, that is vanilla overnight index swap. So answer of the first question. The given swap arrangement is plain vanilla overnight index swap. Now answer for the second part of the question. In that calculation of interest differential. So we'll make the computation of the interest at the floating, then we'll keep that is compute the interest at the rate of fixed and difference of both of them. So date, day, calculation and amount. That is the way we'll make the calculation of answer. So here we have to start from 20th of August, that is Tuesday. The calculation is supposed to be made on the principal amount of 10 crore and the rate of interest is 8.15 percentage. So 10 crore into 8.15% into 1 divided by 360. So 10 crore into 8.15 percentage divided by 365. Because the question is providing that so we have to take 365 days in a year. We have to ignore the decimal working. So I am taking 22,329. Then it is 21st of August, Wednesday. This amount of the interest will be added to 10 crore. So it is 10 crore plus 22329 into the rate of interest for the next day is 7.98 percentage into 1 divided by 365. So 1 crore 22,329 into 7.98 percentage divided by 365. That comes to 21,868. then it is 22nd, that is Thursday. Again, this two interest will be added to 10 crore. So it is 10 crore plus 44,197 into next day the rate of interest is 7.95 percentage into 1 divided by 365. So the amount of interest comes to 21,790.44. So I take 21,790. 23rd, that is Wednesday. So amount on which interest is calculated is 10 crore plus 65,987 into the rate of interest is 8.12 percentage into 1 divided by 365. So the total amount into 8.12% divided by 365. So 22,261. This is Friday, then Saturday and Sunday both together. 10 crore plus 88,248 into rate of interest is 8.15 percentage into 1 divided by 365. $22,348. However, we are required to find it for 2 days because Saturday and Sunday together. So into 2 divided by 365. That is 45,696.94. So I am taking 97. 44,697. Even for Sunday, that is the compounding will not be done. So it is 10 crore plus 1,32,945 into the rate of interest is 7.75 percentage into 1 divided by 365. $21,206, that is 61. So this is the total interest. 22,329 plus 21,868 plus 21790 plus 22261 plus 44697 plus 21267, that comes to 1,54,806. This is the total interest at the floating rate. Now again the total interest at fixed rate. Let us understand and say how to calculate the same. It is 10 crore into 8 percentage into 7 divided by 365. So the amount of interest comes to 1,53,424.65. So we can take 425. 1,53,425. Okay. So this is the total interest at the floating rate. The interest at the floating rate is higher than the fixed rate. So we'll compute the difference. The difference is 1381. So this difference is required to be adjusted between both of them. Friends, over here the amount of interest is not 1,54,000. It is 1,32,945 plus 21,261 comes to 1,54,206. So difference between both of them is 781 rupees. That is the difference. So this amount is going to be settled between both the parties. We can see that the total interest at the fixed rate is 1,53,425 and at the floating it is 154,206. So difference will be adjusted between both of them. So written answer. Differential interest will be adjusted between both of them.
Next question, question number 12. STR Limited's current financial year's income statement reported its net income after tax as rupees 50 crore. Following is the capital structure of the company at the end of the current financial year. Debt is an amount of 80 crore, equity 250 crore, and the total invested capital is 330 crore. That is the capital employed. Following is the data given to estimate the cost of equity capital. Asset beta is 1.11, risk-free rate of return RF is 8.5, market risk premium, that stands for RM minus RF, that is 9%. The applicable income tax rate is 3030%. And you are required to make the computation of the economic value added for the company, and it is required to be computed in lakhs of rupees. That is what's the question which is provided over here. So let us understand and say how to make the computation of the answer. So now we understand that first of all we are required to compute the beta of the levered equity. Yes, because you can see that the beta of the asset is provided to us It means that the beta of unlevered equity is given to us. We have been provided with the capital structure. So we have to compute the beta of the levered equity, and based on that, the cost of equity will be calculated. So answer for question number 12. In that, working note number 1, calculation of beta of levered equity. Now in that, it is equity and debt. Equity is concerned, it is 250 and debt is 80. This is 250 and this is 80. Total is 330. This is the amount. Based on that, so we'll compute the weight, because we need to find the proportion in which the investment is made. So 250 upon 330, that comes to 0.7575. 7576, and 80 upon 330, it is 0.2424. 250 upon 330. Next is 80 upon 330. That is the way weight is supposed to be calculated. So now we understand the formula for beta of unlevered equity, or we understand beta of the asset is equal to beta of levered equity divided by 1 plus debt into 1 minus tax rate divided by equity. We can see that the information is provided to us that the asset beta is 1.11. This is 1.11. Beta of levered equity we do not know, that is supposed to be calculated. 1 plus debt financing proportion is 24. Income tax rate is 30%. Divided by 7576. So now we understand that 0.2424 into 0.7, that is 0.16968 divided by 0.7576. So 0.2240 plus 1. So beta of levered equity is equal to 1.2240 into 1.11. That comes to 1.3586, or we can say it is 1.36. That is the way the beta of levered equity is calculated. Okay. Now based on that, so we'll compute the cost of equity. Cost of equity will be RF plus beta into RM minus RF. What is the risk-free rate of return? Risk-free rate of return is 8.5. What is beta? 1.36. What is RM minus RF? It is 9. So 1.36 into 9 comes to 12.24. That comes to 20.74. That is the way the cost of equity is calculated. Coupon rate is provided to us as 11%. Income tax rate is given as 30%. So cost of debt financing, it is rate of interest into 1 minus t. So it is 11% into 1 minus 0.30, 7.7%. Once we compute the cost of equity and cost of debt financing, then we can make further calculation of weighted average or overall cost of capital. So calculation of WACC, equity plus reserves and surplus and debt financing. Weight into cost. Weight is 7576. (2424). Cost of capital is 20.74 and this is 7.7. 0.7576 into 20.74, that is 15.71. 2424 into 7.7, 1.87. 1.87 plus 15.71, 17.58. That is the way weighted average cost of capital can be found. Now we'll make the computation of the EBIT. So calculation of earning before interest and taxes. That's very simple to find. It is earning before taxes plus interest. We can see that the question is providing the information that the net income after tax is an amount of 50 crore. So over here it is earning after taxes divided by 1 minus t. That is the way it is converted into pre-tax plus interest. What is earning after taxes? It is an amount of rupees 50 crore divided by 1 minus tax rate plus interest amount. The amount of the debt financing is given to us in the question is 80 crore and the rate of interest is given to us in the question is 11%. 80 crore into 11%. So 5050 divided by 0.7, that comes to 71.4286 or 71.43 crore plus 80 into 0.11, that comes to 8.8. So the total comes to 80.23 crore. That is the way we are required to make the computation of the operating income. And the last perky note will be calculation of the EVA, economic value added. It is NOPAT, net operating profit after taxes, minus capital employed into weighted average cost of capital. What is NOPAT? It is earning before interest and taxes into 1 minus t minus capital employed, that is an amount of rupees 330 crore. Into weighted average cost of capital is 17.58%. So we understand that it is 80.23 crore into 1 minus 0.30 minus 330 into 0.1758. that is 58.01 crore. So 80.23 into 0.7, that is 56.16 crore minus 58.01 crore. So it is negative 1.85 crore. That is the way EVA can be calculated. So this is the way we can compute the economic value added. So let us have summary of the working. First of all, we are required to compute the beta of the levered equity, because beta of the asset is indicating that say what is the beta of the equity when there is no debt financing. For that, say first of all we compute the proportion of the each source of the finance in the capital structure, and based on that say we compute the beta of the levered equity. Next, we make the computation of the cost of equity, say taking into account the beta of the levered equity 1.36. Cost of debt financing, for that the rate of interest is given to us in the question, 11% that say we can use, and based on that say the cost of debt financing can be calculated. Next is the weighted average cost of capital, that is 17.58%. Next is the operating income, that is earning before interest and taxes, that is EBT plus interest. So it is EAT upon 1 minus T is EBT plus interest, that is 80.23 crore. The last is very simple, it is NOPAT minus capital employed into weighted average cost of capital. One more thing that I would like to tell you friends is, let's say suppose as a student you make the computation of the cost of equity 20.74% like this. Afterwards you can make the computation of the EVA by using a simple formula like this. It is earning after taxes minus preference dividend if it is there, minus equity dividend, considering that say the rate of equity dividend equal to cost of equity. Even in that case you can get the answer, that is 50 crore is EAT, no preference dividend. Amount of equity dividend will be calculated on the entire equity value, that is 250 crore. So it is 250 crore into rate of equity dividend will be 0.2074. That is, this is the cost of equity. So 250 into 20.74%, that is 85 crore. So 50 crore minus 51.85 crore, so it will be negative 1.85 crore. This is also the way you can make the calculation of answer, which is acceptable from examination point of view. Next, a question from mergers, acquisitions and corporate restructuring. Cauliflower Limited is contemplating acquisition of Cabbage Limited. So Cauliflower is acquiring company and Cabbage is target company. Cauliflower Limited has 5 lakh shares having market value of 40 rupees each. Cabbage Limited has 3 lakh shares and the market value is 25 rupees. EPS of the Cabbage Limited and Cauliflower Limited is rupees 3 per share and rupees 5 per share. Now importantly friends, you must have noticed that cauliflower, cabbage, and then they have changed the sequence, cabbage and cauliflower. So be careful. The management of both the companies are discussing the two alternatives for exchange of the shares as follows. First, in proportion to the relative earning per share. Second, 1 share of cauliflower for 2 shares of the cabbage, that is exchange ratio is 0.50. Calculate earning per share after merger under both the alternatives. Second question is, show the impact on the earning per share for the shareholders of the two companies under both the alternatives. That is what you are required to make the calculation over here. So friends, this is the basic information given to us for cauliflower acquiring company, cabbage target company, number of shares, MPS and EPS. The question is providing us information in the proportion to the EPS. You are required to make the computation of the exchange ratio. So answer of the first part of the question, in that calculation of exchange ratio based on earning per share. In that, it's very simple, dear students. We just have to consider EPS of the target company, that is EPS of cabbage, divided by EPS of the acquiring company, that is EPS of cauliflower. So it is 3 upon 5. So the exchange ratio is 0.60, or we can say it is 0.60:1. That is the way the exchange ratio will be calculated based on EPS. The question is providing further that say the 1 share of cauliflower for 2 shares of cabbage limited. So in case of the second one, exchange ratio is equal to 1 share of acquiring company for 2 shares of the target company. So the exchange ratio will be 0.5, or it is 0.5:1. The question is providing that say you are required to compute the earning per share after the merger under both the alternatives. So let us see that say how to make the computation of the EPS if at all the exchange ratio is 0.60 and if at all exchange ratio is 0.50. Dear students, number of shares provided to us, earning per share is provided to us. So based on that, say the earning after taxes can be calculated for both the companies, and in absence of an information, we assume that the total of both of them is earning after taxes of the merged firm. Accordingly, we will make the computation of the EPS of the merged firm. So please write down answer. Calculation of EPS of the merged firm, or EPS of cauliflower after acquisition of cabbage. So EPS of the merged firm is equal to earning after taxes of cauliflower plus earning after taxes of cabbage divided by number of equity shares of the merged firm. So it is number of equity shares of cauliflower plus number of equity shares of cabbage into exchange ratio. As far as earning after taxes is concerned, it is 5 lakhs into 5. Plus this earning after taxes is 3 lakhs into 3. Whole divided by 5 lakhs plus 3 lakhs into exchange ratio. This is the way we can compute the answer. There are two exchange ratios provided to us. One is 0.50 and another is 0.60 based on earning per share. So 5 lakhs into 5 is 25 lakhs. 3 lakhs into 3, that comes to 9 lakhs. Divided by number of shares are 5 lakhs plus 3 lakhs into 0.5. 25 plus 9, that comes to 34 lakhs. whole divided by 3 lakhs into 0.5 is 1,50,000. That 1,50,000 say plus 5 lakhs, that comes to 6,50,000. Based on that, so we can compute the EPS. So 34 divided by 6.5, that comes to 5.2308. In the next case, the working is going to be similar like this. The only thing is that so the number of shares are going to be different. 5 lakhs plus 3 lakhs into 0.6. 34 lakhs divided by 3 lakhs into 0.6 is 1,80,000 plus 5, 6,80,000. 34 upon 6.8, that comes to 5 rupees per share. This is the way, so we are required to compute the earning per share for both of them. Now we are required to compute the profit or loss to the shareholders of each company for each of the exchange ratio. Let us understand that profit or loss for different exchange ratio. Exchange ratio 0.50, 0.60. Name of the company, it is cauliflower cabbage. Cauliflower cabbage. Post is supposed to be compared with pre. As per the information given, EPS of the cabbage is 3 before merger. So this is 3, this is 3, this is 5, and this is again 5. If at all exchange ratio is 0.60, EPS of the merged firm is 5 itself. So EPS attributable to acquiring company post merger is EPS of the merged firm itself, that is 5 rupees. So we can write over here EPS of the merged firm itself, that is 5. And as far as cabbage is concerned, in that EPS of the merged firm 5 into exchange ratio 0.60, that comes to 3. So what is profit or loss? It is 0 in both the cases. Now friends, what happens importantly, we understand over here that if at all the exchange ratio is based on earning per share, then in that case, of course, it will happen like this, that the profit or loss to both the companies will be 0. This is what we understand. It is a kind of break-even exchange ratio from acquiring company point of view as well as target company point of view. Now when it is 0.50, in that case it is 5.2308. And in case of the cabbage, it would be 5.2308 into exchange ratio 0.50. That is the EPS attributable to it. It is 2.6154. So let me take 2.62. So there is a profit of 0.2308 and there is a loss of 0.3846. So I am writing 0.38. This is the way, so we make the computation of the profit or loss to shareholders of each company. This is the way we are required to make the computation of the profit or loss to shareholders of both the companies for different exchange ratio. Dear students, there is no need to verify the answer, but still if at all somebody wants to verify the answer, then he or she can have a kind of cross verification like this. As far as the Cabbage Limited is concerned, in that say we can see that say the EPS attributable to it post merger is 2.6154 In comparison to the previous one, there is a loss of 38.46 paise. Into number of shares of the Cabbage Limited, which is provided to us as 3 lakhs. Whatever the loss that the Cabbage Limited is having, that itself is a gain to cauliflower. Let us check that. The profit is 0.2308 and number of shares of the acquiring company before merger is 5 lakhs. So 0.2308 into 5 lakhs. That is 1,15,400. It's very close to the answer, not exactly the same. This is the way we can compute the answer. That is, rather we can verify the answer. So the EPS after merger show the impact on the EPS of the shareholders of the two companies under both the alternatives. That is what we have calculated. Next, theoretical questions. Can a company with no commercial operation raise capital via an IPO? That is a question. The answer is of course yes, and we are required to discuss it. Answer of the question is like this. Although the statement a company with no commercial operation can launch an IPO appears to be absurd, but this is a fact that even if a company does not have any business, it can float an IPO. Yes. In recent time, the concept of SPAC, Special Purpose Acquisition Companies, has come into existence. In recent time, the concept of special purpose acquisition companies has come into existence, wherein an entity is set up with the objective to raise the funds through an IPO, initial public offer, to finance a merger or acquisition of an unidentified target with a special time period. So this is very important, friends. There is a specific time period in which you have to complete your task. It is commonly known as a blank check company. The main objective of SPAC is to raise money despite having any operation or revenue. The money raised from the public is kept in escrow account, means a separate account, to make sure that those funds will not be utilized for any other purpose, which can be accessed while making the acquisition. However, in case the acquisition is not made within the stipulated time of initial public offer, SPAC is delisted and the money is returned to the investors. So it is very much logical that whatever the purpose for which you have raised the funds, if at all you are not utilizing it, then it is supposed to be refunded. Shareholders have the option to redeem their shares if they are not interested in participating in the proposed merger. Finally, if the merger is approved by the shareholders, it is executed and target private company or the companies become public entities. Once a formal merger agreement has been executed, the SPAC target is usually publicly announced. New investment opportunity in Indian companies have resurfaced and have set new platform for SPAC transactions. The implementation of SPACs might face certain challenges since India does not have a specific regulatory framework guarding these transactions. The current regulatory framework in India does not support SPAC transactions. Further, as per Companies Act 2013, Registrar of the Companies is authorized to strike off the name of the companies that do not commence operation within 1 year of incorporation. The SPAC generally take 2 to 3 years to identify, target and performing the due diligence before it could be operationalized. Its name can be stricken off and hence enabling the provisions relating to SPAC need to be inserted in Companies Act in order to make it functional, operational in India. Though SPAC do not find acceptance under SEBI, it does not meet the eligibility criteria for public listing. However, SEBI is planning to come out with a framework for SPAC. IFSCA, the International Financial Services Centers Authority, being the regulatory authority for the development and the regulation of financial policies, financial products and financial institution in Gujarat, International Financial Tech City has recently released a consultation paper defining critical parameters such as offer size to the public, compulsory sponsor holding, minimum application size, minimum subscription of the offer size and so on. SPAC approach offers several advantages over traditional or conventional initial public offer, such as providing the companies access to the capital even when market volatility and other conditions limit liquidity. SPACs help to lower the transaction fees as well as expedite the timeline in becoming a public company. Raising money through SPAC is easier in comparison to traditional IPO since SPAC has already raised money through an IPO. This implies the company in the question only has to negotiate with a single entity as opposed to 1,000 individual investors. This makes the process of the fundraising a lot easier and quicker than through initial public offering. The involvement of the skilled professionals in identifying the target makes the investment a well thought and well governed process. However, the merger of SPAC with a target company presents several challenges such as complex accounting, financial reporting, registration requirement. To meet a public company readiness timeline and being ready to operate a public company within a period of 3 to 5 months of signing the letter of intent. It is typically more expensive for a company to raise money through a SPAC than an IPO. Investors' money is invested in SPAC trust to earn a suitable return for up to 2 years could be put to better use elsewhere. This is the way, so we are required to write answer for the question. Next question, question number 15. Mr. R has completed his studies and wants to start his new online business. For a successful online business, there are various expenditure costs with regards to advertisement, application development. To make the business successful, he wants to raise funds. Explain some of the innovative sources of the funding for funding a startup. This is one of the very popular question which has been tested in examination for approximately 2 times, provided by the institute in the earlier its publication also. So very important question from examination point of view. Dear students, there are 9 innovative methods for the purpose of raising funds. The 9 innovative methods are like this. The first is that you will be having the personal finances. As far as the personal funding is concerned, it is consisting of your own savings which you will invest in the business. Suppose I have done my job for 10 years in an industry, and after working for 10 years I think that I am confident enough to do that business. During this 10 years, whatever the job that I have done, with that whatever I have earned, with that I can start my own business. That is what we understand is the personal financing. The second is the personal credit line. Going with the same example, what happens that taking into account my transactions with the bank, taking into account my income tax returns over this last 10 years, I will be eligible for certain amount of the personal loan. I will be eligible for credit card loan. Whatever these kind of the loans for which I am entitled for, that I can take and I can make investment in the business. Of course, friends, these are not like the innovative sources of the finance. Are they innovative? No, we already know about it. But still we understand that they are very important. Why? Because whenever you are approaching to someone for the purpose of raising funds, then anybody would like to check, anybody would like to see that how much investment you have made in the business. If at all you have made the sufficient funds, investment is made by you on your own or on your credit lines, then in that case the others will feel confidence in making investment in your business. Because if at all the business is not going well, if at all your own funds is invested, you will be dedicated, you will be having full determination to recover from that business. The third is the family and friends. As far as the family and friends is concerned, in that we understand that suppose my dad is making investment in my business, my uncle is making investment in my business, or one of my friend is making investment in my business. That is what we understand is the family and friends. Preferably these like the whatever the funds that I am borrowing from my friends or from my uncle, for that preferably it should be in the writing, terms and conditions should be clarified, so that there is no the stressful relationship later on. Next is the peer-to-peer lending. As far as peer-to-peer lending is concerned, in that the kind of explanation which has been given over here by the institute is that there is the group of the person who will come together and they will lend to one another. That is what they have explained as the peer-to-peer lending. Next is the crowdfunding. Crowdfunding is a kind of innovative method for the purpose of raising funds through social media, through internet, through the network, that is you will be able to raise the funds. There are a number of crowdfunding platforms over there, you can put your idea and you can ask for the funds. You can tell to the investors that say I will give you the return either in form of cash or I will give you the return in form of kind. For example, say I want to that is say I am a musician or I am a singer and I want to say record say song, and for that say I want to book a some studio, or there are certain expenses which I am supposed to incur. For that say I am raising the funds say through crowdfunding platform. I may tell to the investor that I will give you say my the video cassette, or I'll give you say an entry to an open concert, or I can say that say I'll give you some return in form of cash. Something like this, a commitment can be given. Next is the micro loan. The term micro is indicating that say it is say the small. Micro loan stands for that whatever the fund requirement that I have, say I may not be able to get say that funds only from one person. I may able to get the funds say from the different person, and everybody would be ready to pay some amount of the funds to me. So whatever that some amount of the funds say for which I will be able to get the loan is micro loan. Vendor financing. Vendor financing is say a kind of financing wherein you can relate something like this. Let us say that say I am going to buy an LC, that is say LED. Suppose say I go to buy an LED say in a showroom. What happens that say whatever the LED that say I want to purchase, say for that say I will be able to get the financial arrangement from somewhere there only. That is what we understand is a vendor financing. Suppose I want to purchase a product of the Bajaj company. Then when I go to buy that product of the Bajaj company, then the Bajaj company itself is having say a financial arrangement, that is the Bajaj Financial Services say will give a loan to me. So what will happen? I will take loan from the Bajaj Finance, I will buy the product of the Bajaj company. That is what we understand is a vendor financing. So with that, so the Bajaj is able to make the profit on the business also, and will be able to earn the interest also from me. That is a vendor financing. Purchase order financing. Purchase order financing is something like this. You can have some kind of understanding in this way. So there is a company which is able to get the order from the customer. For the purpose of supply of the product, let us say that the company is having say time period of 2 months. And after that, say there will be some credit period. Let us say the credit period is say 3 months. In order to supply the product within 2 months, so the company is required to say purchase raw material from supplier. In order to purchase the raw material from supplier, company is approaching the supplier. However, the company is new. That is the reason so the supplier is reluctant so to offer credit to the company. So now what the company can do? So the company can go to a financer, asking the financer that say I have some ready-made order with me. Whatever the ready-made order which I have, say against that say I want to say take loan from you. So the company is going to basically say take loan from the financer, considering that say I have ready-made order with me, and in order to make payment to the supplier, I don't have funds. So the financer may make the payment to the supplier, and the supplier will supply the raw material to the company. The company will sell the product to the customer, and with that say the company will be able to raise the funds. Of course, so the financer is going to charge interest say for this kind of arrangement, and it may ask the customer say to make a certain portion of the payment directly to the financer. This is say something what we understand is like the purchase order financing. Factoring is not something a new concept that say we have. Factoring is a very simple concept that we have, in which we understand that say whatever the goods that you already have sold and you have given certain credit period to the customer, you sell your accounts receivable to somebody in a way that's to factor on a discount basis. The bill discounting and the factoring is going with the same concept. Of course, over here the factoring is say quite broader, in which say you will be say giving the collection work also to the factor, and for that the factor will charge interest to you. Dear students, from examination point of view, writing the head points is very necessary, and that you are required to properly remember from examination point of view. I can say something like this. As far as the first 2 points are concerned, it's very simple. That is a person and the family. That is, you start the business with your own funds. First 3. It is the person financing, person credit line, and family friends. These 3, something very simple that say you can remember. 4th and 5th are like the innovative method, peer-to-peer and crowdfunding. So those things are very simple to remember. Vendor financing, purchase order financing, both of them are going again in the same direction, because you approach to the vendor who gives the finance, or otherwise you get the finance say from some outsider. Micro loan is a special point, and the factoring is say something that say you always remember, since you already have done it at say your intermediate level. So 9 points that you can remember like this. 1 is the person financing, that is your own funds. 2nd is a person credit line, based on my own credit line I will be able to get the funds. The 3rd is say the family and friends. 4th is peer-to-peer. 5th is a crowdfunding. 6th is micro loan. 7th is say the vendor financing, Bajaj company example. 8th is purchase order financing, and 9th is factoring receivable. These are the 9 methods that you have. So for purchasing, vendor financing, purchase order financing. Once you sell, afterwards it is factoring. That is the way you can remember these 9 points. That's very simple. In that also you have to write the relevant things that say what we have discussed. If at all you are able to mention exactly what they have given, then in that case it's great. However, writing in your own language is also acceptable from examination point of view, and the institute will give you full marks for the answers that say you have written completely correctly. Every startup needs to access the capital, whether for funding a product, acquiring machinery, inventory, or paying salary to its employees. Most entrepreneurs consider bank loan as a primary source of the funds, only to find out that the banks are really the least likely to be benefactors for startup. Thus, innovative measures include maximizing non-bank financing. So friends, over here we understand that since the risk is more in case of the new the financing, that is the reason we are always, that is bank is always reluctant to give the finance in respect of the startup. Here are some like the source of the funding. Primer, that is the person financing, your own investment, 10 years of the job. It may not seem to be an innovative method, but you may be surprised to note that most budding entrepreneurs never thought of savings any money to start up the business. This is important because most of the investors will not put money into the deal if they see you have not contributed any money from your personal sources. So to gain confidence of others, you have to put in your own funds. Personal credit line. One qualifies for the personal credit line based on one's personal credit efforts. Credit cards are a good example of this. However, the banks are very conscious while granting the personal credit lines. They provide this facility only when the business has enough cash flows to repay the line of credit. So even though friends over here they have provided non-banking, but still this is what we understand that it is a kind of the loan that you will be able to get from the bank only, and you will be able to get this kind of the loan only if at all you have enough of the cash flows. Familiar friends, these are the people who generally believe in you without even thinking that whether your idea will work or not. However, the loan obligation to the friends and relative should always be in the writing as a promissory note or otherwise. Peer-to-peer lending. In this process, the group of the people come together and lend money to each other. Peer-to-peer lending has been there for many years. Many small and ethnic business groups having similar faith or the interest generally support each other in their startup endeavors. This is what they have provided. However, friends, my understanding for peer-to-peer is slightly different. I am just sharing my own view with you. Peer-to-peer lending is very similar to the concept of Ola, concept of Uber, wherein we understand that there is a platform through which I book a car, I book an auto, and I go from one place to another place. I make payment of 100 rupees to the Ola cab. Then that 100 rupees is split between two parties. One is driver and another is Ola or Uber, that is the platform through which I have booked the vehicle. So Ola or Uber is only a platform through which I can do the dealing. Similarly, like stock exchange, whenever you are doing a transaction on stock exchange, then stock exchange is not doing a transaction with you. Somebody else is doing a transaction with you through stock exchange. This is what we understand. So over here, peer-to-peer lending is something like this. So if at all I want to raise the funds through peer-to-peer lending platform, that is again it is a kind of the platform on internet through which you can raise the funds. Then in that case you have to create your profile. You have to tell the amount of the funds which you want, what is the rate of interest that you can give, something like that. If at all the investor is wants to make investment, then in that case the investor will make investment in you, not otherwise. This is what we understand is the way it works. One of the advantage of the peer-to-peer lending or the crowdfunding platform is, in comparison to State Bank of India or Bank of India, what happens that you will be able to get higher interest amount. Next is crowdfunding. Crowdfunding is the use of small amount of capital from a large number of individuals to finance a new business initiative. Crowdfunding makes the use of easy accessibility of the vast network of the people through social media and crowdfunding websites to bring the investors and entrepreneurs together. Now, importantly, friends, in case of the crowdfunding, what happens at you can raise the funds for more than one purpose. Over here, of course, we are talking about the startup. So you can raise the funds for the startup and you can give the reward either in form of cash, or you can give the reward in form of the kind. Micro loan, that is small amount of the loan, as small loans that are given by the individuals at lower interest rate to new business ventures. These loans can be issued by a single individual or aggregated across a number of individuals who each contribute a portion of the total amount. Vendor financing. Vendor financing, in that, remember the example of the Bajaj company. Vendor financing is a form of the financing in which a company lends money to one of its customers so that he can buy products from the company itself. Vendor financing also takes place when many manufacturers and distributors are convinced to defer the payment until the goods are sold, in a way that the credit will be given by the vendor itself, say for the purpose of making payment, some more credit will be given to you. This means extending the payment terms to a longer period. Example, 30 days payment period can be extended to 45 days, or 30 days, that is payment period, is extended for 60 days. However, this depends upon one's own credit worthiness. Purchase order financing. The most scaling problem faced by startup is the inability to find a large new order. The reason is that they do not have the necessary cash to produce and deliver the product. Purchase order financing companies often advance the required funds directly to the supplier. This allows the completion of the transaction and the profit flows up to the new business. So you are having the ready-made financing, that is the order. Factoring is very simple, exactly the same thing that you have studied at your second level. In this method, the facility is given to the seller who sold the goods on the credit to fund his receivable till the amount is fully received. So when the goods are sold on credit, the credit period, that is the date up to which the payment shall be made, is, for example, 6 months. The factor pay most of the sold amount. Most of the sold amount means from the total value of the debtors, certain amount is kept in form of margin, certain amount is deducted in form of commission, and certain amount is deducted in form of interest upfront and rest amount later. Therefore, in this way, startup can meet his day-to-day expenses. This is what we understand. Further, you can always mention something like this further, that there are two types of factoring services, recourse and non-recourse. In case of recourse factoring services, the company would be responsible for bad debts. In case of non-recourse, the factor would be responsible for bad debts. Like that, say something like this extra also you can mention for factoring services. A small summary of the entire working. Question number 1 is of duration. I would say that this is a good question. It has already been asked in examination earlier, but still there is a good point over here, that is the immunization concept, in which a student is required to understand that the investment will be made in combination of two securities. This is the security valuation security. In that we have the convertible security. In that these are certain good questions, otherwise these are very simple questions. Again, this has already been covered by the institute in its material earlier. This is a very simple question, very simple question of portfolio management, not like very important from examination point of view. This is again, fourth question is of portfolio management, which has been provided by the institute in its material earlier. Simple question. The only in the third part of the question, you have to understand that a certain portion of the investment will be sold, and then say for the same amount we will borrow, so that the risk increases. In case of the mutual fund, this is again a very simple question. Sharpe ratio, Trainer's ratio, Jensen's alpha to be calculated. Derivative, in that again this is a simple question, in which we understand that we are required to take opposite position in the futures contract for the purpose of hedging. Again, this is a very simple question, already covered by the institute in its publication. Calculation of the beta, index transaction, risk-free security transaction. In that in my opinion, this is a good question, wherein we understand that the beta of the portfolio will be revised 0.91 only. This may be 2% or 25%. Even in that case, the answer is not going to change. This is again a good question, already provided by the institute in its publication earlier, asked in examination, but still this is a good question. Unless you have done the written practice, it may be difficult for you to do an answer in examination, because you are having the borrowing in dollar currency and you are required to make the gain in the pound currency. Question number 9 I found to be a good question, with the reason that's over here. So this is a point which they have provided to us. Similar to this question have already been provided by the institute. However, you already have an amount of 25 lakhs as a new point, and with that, so you are required to do answer. So a good question from examination point of view for you to do. Question number 10 is again a simple question. Very similar to this, the question has already been provided by the institute. Then question number 11, again a simple question. In that, say again similar to this question provided by the institute. See over here, this time the question says that you are required to name that what kind of swap arrangement is. So it is plain vanilla overnight index swap. In earlier questions that they had asked, they were providing this kind of name, but this time they have asked this name. Question number 12, again a simple question. For calculation of the economic value added, beta of asset stands for beta of unlevered equity. Mergers and acquisitions, again a simple question. Calculation of exchange ratio, profit loss. Just one small point, you can see that they have changed the sequence. Cauliflower, cabbage, cauliflower, cabbage, then cabbage, cauliflower. So when this kind of small point is changing, you need to be careful. The IPO question is a good question, that is a new one, and this is a simple question similar to that, has been covered by the institute number of times earlier. On behalf of Navkar Digital Institute, I wish you all the best, say for your preparation and for examination.